Okay, hello. I'm sorry I left the meeting by mistake. Sorry about that. I was trying to share my screen and then I clicked something else entirely. Um, where's okay? Wait a second. Okay, so can everyone see my screen? Just type in the chat box that you can see my screen. Just want to be sure.
Yes, I am ready. Your screen is visible.
Okay,
Yes.
okay, all right. So I'll go ahead. So last time out, we stopped at I think we covered the basics of the three statements, or let me say we started from understanding what financial analysis is about, sources of information to conduct financial analysis and the essence of conducting financial analysis. And then we had a look through the different components of the financial system. I mean of the financial statement, different components of financial statement, focusing on the income statement or statement of profit and loss, the balance sheet, or what I told you is also known as statement of financial position, and also the cash flow statement. So we focused on those three statements and we looked at all the different components that make up that financial those components of the financial system. So of the financial statement, sorry. So we also looked at the various techniques to conduct financial analysis, different methods that we typically use. We would practicalize some of these examples. We look at horizontal analysis, vertical analysis, and then also ratio analysis. So we look at the practical of the aspects today. But in the last lesson, we were on, I was explaining the different categories of ratios we have. We're going to practicalize, we're going to do some practicals on, how to calculate these ratios so that you can understand, how they are calculated. But just let me pick it from the top again, right? From profitability ratios. Last time I told us that profitability ratios basically focus on trying to analyze the ability of a business, to generate profit. How profitable is a business? You can know how profitable a business is, not just by looking at net profit or gross profit or things like that, but by also looking at the ratios. It tells you, so for example, if you want to know if a business generates 100 naira in revenue, how much of that would be net profit, right? That is what net margin will tell you. If you can remember what net profit is your total profit, after you have deducted your cost of sales, your operating expenses, which includes, administrative expenses, selling and distribution expenses, or selling and marketing expenses, as some companies call it in some cases, and then you've deducted your taxes, you deducted your interest expense, and any other income that, the business generated from, that is not from the ordinary business of the company, that is not from the core business or the core operations of the company. And I can remember I explained that there's a difference between income generated from ordinary business of the company or the core operations of the company and income that is not generated from that. For example, a furniture company selling maybe a vehicle that's maybe one of their delivery vans. If a furniture company should sell one of their delivery vans, that is not a revenue to the company. That is just other income. Is proceeds from disposal of one of their fixed assets. So that's different from when they sell furniture and things like that. So also a company that deals in selling cars, right? When they sell, maybe they sell some of their furniture or things for scrap, right? The sale of that furniture for that company that sells cars is not revenue. So just a bit of recap on that again, but the key focus of what I'm trying to drive home here in terms of profitability ratios is that for you to sometimes all these ratios in terms of profitability ratios would help you to know how much a company, for example, how much net profit or gross profit or operating profit they can generate for every unit of revenue that they generate. So if a company's gross margin, for example, is 50%, it means that for every 1 naira of revenue they generate, 50 kobo will be in gross profit, right? Same way, if you're looking at a return on equity, like one of the ratios we have on that profitability ratio is return on equity. Return on equity helps me to know how much profits I will get for my investment in the company. Now, it's important for me to differentiate. So that investment in the company is going to be measured based on book value, that is total equity in balance sheet. So I don't want to confuse you. So when you invest in, let me just give a bit of clarification. When you invest in a company, right, the shares you buy in a company, the book value of your investments in that company is based on the balance sheet total equity. So when you look at the balance sheet, I'm sure you'd have gone through a few of the materials I sent across, and then maybe you've studied a few financial statements. The total equity segment is the book value of equity investment in that company. That's the book value. That is the value based on the books, based on balance sheets. But there's also the market value. So, for example, you're analyzing CAP, right? And CAP is listed on the Nigerian Stock Exchange. CAP also has a market value. That is the value at which it trades at on the stock exchange. So that market value of equity is different from book value of equity. So when we are referring to return on equity, we are referring to the return on the book value of your equity investment in the company. So if I want to know, how much I would get in return for every maybe 100 naira I invest in a company, I would know that by return on equity. So if a company's return on equity is 20%, I know if I invest 100 naira in this company, I will get a return of 20 naira. So from there, you can understand how the formulas work. So the reason why I explained it that way is for you not to cram the formulas, is for you to understand the basis. And that's why I didn't put formulas on this slide. So when you say gross margin, it is gross profits relative to sales or revenue. Net margin, net profit relative to sales or revenue. EBITDA margin, EBITDA relative to sales. If it's cost margin, cost of sales relative to sales. If it's any type of margin is relative to sales, in most cases. Return on equity, like I mentioned, is net profit or return attributable. So like I mentioned the last time, a company may have net profits, but all the profit is not attributable to all the equity investors in the company. So there might be minority interest holders in the company. So a company may not be only owned by all the shareholders in that company. In the case of CAP, is not that case. UACN owns 100% of CAP. Is a wholly owned subsidiary of UACN, if I'm correct. I think I'm correct about that. But some companies are not only owned by the equity holders, right? There are also minority interest holders. So whenever you're calculating return on equity, you are focusing. So if you're calculating return on equity for equity investors in the company, that is excluding minority interest holders, you'll be focusing on profit attributable to those shareholders. When we are calculating return on equity for the company as a whole, that is, you just want to compare the return on equity for company A to return on equity for company B, then you can do the total net profit. Either is attributable to ordinary shareholders or is minority interest. You sum everything together and divide it by total equity. So that's return on equity. Return on assets is net profits divided by total assets. Return on capital employed is net profits divided by capital employed. Now, capital employed so there's a way of calculating capital employed. I will explain it now. There are so many iterations of capital employed, right? Different, you read a book, or you read one paper, they define capital employed as, some will say total assets plus only loans and borrowings. Some people will say total assets plus long-term liabilities. So different iterations of capital employed exist, right? But in most cases, what we always see will be capital. So let me give you the intuition. Let me explain. So again, I don't like to give formulas so that you understand. Capital employed is capital deployed to run the business, basically. What capital is deployed to run the business, to generate this return. That is what capital employed is referring to. Is looking at how much capital was deployed in running the business in order to generate the profits that we have generated. So that's what capital employed is basically focused on. So when you're calculating return on when you're calculating return on capital employed, you're just focusing on the capital that is deployed to basically achieving the profits that the return that you're trying to calculate, return on capital employed for. So that's just the key focus of return on capital employed, right? So that's I've spent a few minutes on profitability ratios. Still have a lot to do. So let me quickly move to efficiency ratios, right? I think I explained efficiency ratios the last time, but let me just quickly recap that. Asset turnover ratio, okay, so for efficiency ratios or activity ratios, the whole idea is to measure how well a company is using its balance sheet. So remember, under component of financial statements, we have the balance sheet or statement of financial position, whichever you want to call it, and the income statement, right? How well a company uses its balance sheet. Remember, balance sheet houses the total assets of the company, and the total asset of the company is what is used to run the business to generate revenue or to generate profit or to generate return, whichever way you want to measure results or end results, right? So if you want to look at one of the ways you can use to analyze a good business is to look at how well are they even using these assets, right? Now, there are some nuances to using efficiency ratios to compare companies, and I will give you a very good example. But let me explain how these things go. So the whole idea is you have 100 billion naira worth of assets. You generated revenue of 20 billion. How well have you used your assets properly? Have you sweat your assets? Basically, that's the way we say, are you sweating your assets properly? Are you generating value for those assets that you have on your balance sheets, right? That is what efficiency ratio is trying to measure. So I guess that drives home the point, right? And we have different types. You have asset turnover ratio that is focusing on revenue relative to total assets, right? How well are you using your total assets to generate revenue? We have fixed assets turnover, right? That one is focusing on how well you're using your fixed assets to generate revenue. Once you see turnover, you just know that's revenue. Inventory turnover, that one is looking at how quickly you are converting your inventory to revenue. So remember, if you are a company that you have inventory that you sell, right? One of the ways you can also measure efficiency is how quickly are you turning over your inventory. So if you buy goods worth so a good example is a petrol station. A petrol station, today at the beginning of the month, buys maybe a truck of PMS. A truck of PMS is in some cases 33,000 liters, in some cases 45,000. Let's just say a small truck, 33,000 liters, right? And then you buy 33,000 liters of fuel. That is your inventory in your stock, right? In wherever your storage tanks or whatever, right? That is 33,000 liters. Now, if you sell 1,000 liters per day, it means it takes you 33 days to turn over that stock, right? So that is just looking at the amounts, that's just looking at the volume that you sell daily. If you are calculating inventory turnover, it's basically the cost of goods sold and average inventory. So actually, that's the focus of inventory turnover, is the cost of goods sold, because remember, your inventory is in cost. So let me explain the reason why. Again, it's intuitive, right? You don't have to get confused about it, because I know I mentioned once you see turnover is related to revenue. Asset turnover is revenue and total assets. Fixed asset turnover is fixed assets, revenue and fixed assets, right? Inventory turnover is inventory and cost of goods sold, so not revenue. And I will explain the reason why. Revenue is based on your selling price. Cost of goods sold is based on cost, right? And your inventory, in most cases, inventory is always measured at cost, right? So inventory you have so that stock that we have of PMS that I used as an example is we are measuring that inventory value at cost, right? So it's always advisable to compare with cost of goods sold. So if I have 33,000 liters and I sell 1,000 liters a day, I will measure my 1,000 liters based on my cost of buying that 1,000 liters, and then the 33,000 that I have in my storage tank will be my inventory that I'm measuring at cost, right? And by comparing by basically dividing the two, I'm able to know how quickly I am turning over my inventory. So if you want to buy a petrol station today and they turn over their inventory 33 times, that's 33,000 divided by 1,000. And then the other one, they have maybe 33,000 liters, but they turn it over 20 times, meaning in 20 days, they will exhaust 33,000 liters. Whereas the other petrol station will take 33 days, right? So that means that or the second petrol station has a better turnover rate on its inventory, and all other things being equal, right? If they are equal on all other metrics, you rather buy the second petrol station because you are able to realize your revenue faster. So that's just the idea. Efficiency. How efficient are you in using your assets? That is what efficiency ratios measure. When we do examples, you see the formulas and how to calculate them, but I just want you to have the good understanding of what they measure. And so once you see them, you have an idea what they lead to. Same thing, payables turnover, receivables turnover. Then I have some short words here. This DIO means days of, I think I gave the full meaning, I can remember giving the full meaning of this. Days of inventory outstanding, days of payables outstanding, that's DPO. DSO is days of sales outstanding, and CCC is cash conversion cycle. All that are sort of spin-off of all these turnover formulas. When we begin to calculate, you will see what I mean. The idea of days of inventory turnover is referring to that 33 days that I calculated. Inventory turnover is the inverse of that 33 that I mentioned earlier. So I said 33,000 inventory divided by cost of goods. So 33 divided by that one. I'm just using so I'm assuming a liter is 1 naira, right? I'm assuming a liter is 1 naira. So if a liter is 1 naira, you have stock of 33,000, you sell 1,000 daily. Your days of inventory outstanding is 33 days, while your inventory turnover is the inverse. So that's why I'm saying it's just a spin-off. Days of payable outstanding is a spin-off of payables turnover. So you are just inversing the answer you have for payables turnover, and the same thing with days of payables outstanding, same thing with days of sales outstanding. Then cash conversion cycle is basically the sum. Cash conversion cycle is days of inventory outstanding plus days of sales outstanding minus days of payables outstanding, basically showing how quickly you are able to convert your inventory to cash. I'm just mentioning all the formulas, but when we do calculations, you will understand how all these ratios are calculated. But speaking to cash conversion cycle specifically, the whole idea of cash conversion cycle is when you buy stock of goods today, how quickly are you converting that stock to cash? That is what cash conversion cycle is measuring. And that is why you see it saying days of inventory outstanding. That is, how many days does it take you to sell your inventory, right? Now, when you sell inventory, you sell some for cash, you sell some on credit, right? Depending on your type of business. So when you sell some of credit, you give your creditors time to pay. That is what days of sales outstanding is measuring. How quickly do you get your payments back from your debtors, right? Then days of payable outstanding is referring to the people you are owing. How quickly do you pay them? Right? That's what days of payable outstanding is measuring. How quickly do you pay them? So if I want to calculate how quickly I'm able to convert my stock to cash, all I need to do is my days of inventory outstanding. How long does it take me to sell this stock, right? Then how long does it take me to get the ones that I've sold on credit? Because remember, when you sell the stock, then you collect payments. If you didn't collect your payments cash, you still have to wait for more days to get your payments your payments in cash for the ones you sold on credit. So that's why you have to add the days of sales outstanding. So days of inventory outstanding plus days of sales outstanding, then you subtract days of payable days of payable outstanding, and that will give you your cash conversion cycle. But I will show us how to calculate it when we begin to do the calculations. Liquidity ratios. So we went from efficiency and activity ratios. Liquidity ratios. Liquidity ratios basically measure a company's ability to meet its debt obligations using its short-term assets, basically. So the whole idea is, let me explain. As a company, right? Remember, I think you should be able to remember from our last class, right? We have current assets, non-current assets, right? And then we have current liabilities and long-term liabilities. So what liquidity ratio is trying to measure is that, remember, current assets are assets that are convertible to cash or have a lifespan of less than 1 year, right? That means they are easily converted to cash. So that is why liquidity ratio focuses on your ability to use your current assets to meet your outstanding liabilities. So that is what liquidity ratio is trying to measure. Liquidity ratio is saying how quickly, with your current assets, your cash, your inventory, your receivables, your maybe if you have prepayments, accruals, how quickly are you able to convert your current assets to cash? How quickly can you, if you convert it to cash, how quickly can you convert it to cash to satisfy your liabilities, your liabilities on your balance sheet? So there are different liquidity ratios, right? And so we have the major three ones that you always see will be current ratio, asset test ratio, or quick ratio. Some people call it quick ratio, and cash ratio. I'll explain to you what each of those ratios measure, right? But the whole idea, like I've mentioned on liquidity ratio, is if for any reason you quickly need cash to settle any debt that is arising, or any debt that you need to quickly settle, how quickly can your current assets help you to settle that? Now, what are the formulas? What different variation of formulas do we typically use to measure how good a company's liquidity is? One is current ratio. Current ratio basically looks at how quickly can all your current assets meet your current liability. So when you want to calculate current ratio, you just see your current assets divided by your current liability. That's what current ratio is about. So you can just look at what current assets, current liability. How quickly can your short-term assets meet your short-term obligations? Then asset test ratio, or what some people call quick ratio, and you would understand why some people refer to it as quick ratio. Asset test ratio is saying that you can't quickly convert all your assets, all your current assets to cash. One of the main assets that you cannot quickly convert to cash is inventory. You can imagine a company maybe that sells, say, electrical appliances, for example. You already have huge stock or inventory of electrical appliances, and then you need cash. The truth is, it will probably take you a while. You probably even carry some of that stock over into the next financial period. So the truth is, there's a very good chance that you can quickly convert that inventory to cash. So asset test or quick ratio is saying, let us exclude inventory. Let us look at all other items that are quickly convertible to cash. So for example, your cash in bank, you can quickly redeem it. Maybe if you have any investments in short-term securities like treasury bills, fixed deposits, any cash equivalent, how quickly can you convert that to cash? Your debtors, so people that own you, how quickly can you get that one? You are most likely going to be able to get your money back from them. Maybe you have a credit payment period of 30 or 60 days. That is faster to get compared to inventory that you may not sell for another 9 months, or even in some cases carry over to the next year, right? So asset test ratio is saying, let us measure your ability to meet your short-term liabilities with your short-term assets, but excluding inventory. So quick ratio, so you can see why it's called quick ratio, that is faster than current ratio. So quick ratio is current assets minus inventory divided by current liabilities. That's asset test ratio. So I don't want you to cram the formulas. Just look at understand the intuitiveness. I didn't read any book before coming to this. So over time, when you understand the dynamics of how these things work, you'll be able to explain and apply all these formulas and all these ratios appropriately at different points in time. So that is asset test ratio. Cash ratio, from the word cash itself, cash ratio is now a more extreme version of liquidity ratio, right? Cash ratio is saying, forget all the inventory, forget your receivables, forget all those things that only focus on cash and cash equivalents. When I'm saying cash and cash equivalents, that is your cash in bank, your cash in hand, your treasury bills, your short-term deposits, that you can quickly tell the bank, please cancel my deposit, return my money back into my account. You can do that within 24 hours. So cash ratio is saying all your cash and cash equivalents, how quickly can you use it to finance or pay down your current liabilities if all of them fall due? So cash ratio is basically saying cash and cash equivalents divided by current liabilities. That is what cash ratio is saying. So that is liquidity ratios. We go straight to solvency, or what some people call leverage ratios. So whereas liquidity ratio is focusing on short-term obligations, leverage ratio is saying, let us look at long-term obligations. How easy, basically look evaluating the capital structure of a company. Is a company too leveraged, or are they, what are the capital structure of the company is optimal? Basically the whole idea is how easy is it to meet up or to pay down all your outstanding long-term liabilities using your either your assets or your equity, or anything that's to do with your assets or equity. You will understand when we begin to discuss all the different variations of leverage or solvency ratios. So that's the whole idea of solvency ratios. Whereas liquidity ratio is focusing on your short-term obligations, leverage or solvency ratios are focusing on your long-term obligations, right? And so let's look at some examples, right? So one of the examples we have is debt to equity ratio. So debt to equity ratio, the idea is to look at your total debt, your total loans and borrowings compared to your total equity, right? If I put your total debt here, and I put your debt to equity, for example, is maybe, say, 20%, right? What that means is your total debt is just 20% of your total equity. It means you are not leveraged. So if all your borrowers, or your borrowers, you borrow, whichever, all your creditors, let me use creditors. If all your creditors decide today that we want you to pay our money back today, if your debt to equity ratio is just 20%, it means with your equity, you can pay off your debt without having any issues, right? Whereas if your debt to equity is 150%, or maybe 1.5 times, if you are using some people calculate it in percentage, some people calculate it in times, right? But so if your debt to equity ratio is maybe 1.5 times, or maybe 100 times, or 150%, right? What that means is your debt is 1.5 times your equity. So if all your debt should mature today, your total debt will swallow your equity, and you will still be owing money. So that's the whole idea of debt to equity. So it focuses on your your debt obligations, right? Your core debt obligations, and the ability of your equity capital to cover it. We also have debt to asset ratio. We have debt to asset ratio, that is debt to total asset ratio. Some people do debt to fixed asset ratio. That is, if we sell all your fixed assets today, can your fixed assets cover your debt? Some will say debt to total assets. If we sell all your total assets, that is, we sell your inventory, we sell your machinery, your PP, your buildings, your real estate, everything, we sell everything today, is it enough to meet up to pay down your total debt? So that is also another formula. So that's just basically what solvency and leverage ratios are about. Now, the last category of ratios that we have is coverage ratios. Now, coverage ratios are, so there's no, how would I put it now? There is no broad, you can't say there's a broad definition for what coverage ratios, for what they do, right? Because each of the different type of ratios, they sort of do, they do different things, but in a similar way. And I will explain what I mean. So the way you can generalize coverage ratios is to say, basically, coverage ratios measure the ability of a company to use their earnings to finance obligations to providers of capital. That's basically like what coverage ratio tries to measure. How, from the earnings this company is generating, how easy is it for this company to finance return to providers of capital? Remember, for every company, right, there are two providers of, there are mainly two providers of capital, whichever way you look at it. You have debt and you have equity. Remember, go back to our balance sheet. Liability plus equity is equal to total assets, right? So you bring your own capital as a business owner, you borrow money from other people, you join it together to buy the assets that you're going to use to run the business, right? So remember that. So the providers of capital in the business are the people that provided debt capital and the people that provided equity capital. Now, the return for the providers of debt capital is interest, right? You pay them interest on the debt they provided to you, except if it's maybe an interest-free loan or something. But in a lot of cases, right, there are no interest-free loans. If there's any interest-free loan, you're probably getting a grant or something, and maybe if it's a zero coupon bond. But even if it's a zero coupon bond, there's an implied interest on it because, don't let me begin to go into all those technicalities. But the whole idea is you have a provider of debt capital. On a general level, their return is interest. You have provider of equity capital. On a general level, the return for provider of equity capital from a business is dividend. They can, if the stock is listed on the stock exchange or they sell the company to another person, they can earn capital gains, the difference between how much they invested and how much they sold it for. But that is not within the context of what we are discussing. What we are looking at is the return the company can pay the provider of the capital, right? So for an equity holder, your return from that business is dividend, whichever type of dividend it may be, normal dividend, scrip issue, as referring to bonus issue, or special dividend, or whatever classification you want to put it. Your return from a business is dividend, right? So coverage ratio tries to measure the ability of the business, of the company, to make returns to the providers of capital. So when you pick dividend coverage ratio, from what level? So when you come to, let's go back here. From what level in the income statement? So let me try and make this a bit interactive. So go to the chat box now and tell me what components, so what item on the income statement will the providers of equity capital get their return from? So which item on this income statement, from which item will you deduct or will you pay providers of equity capital? I think my question is clear. So just drop it in the chat box. I want to see. Okay, Tijani Lawa said net profit. I need more people. PAT, same thing. Akikumi Adebayo, okay. Can I get more responses? We have 19 participants on this call. Well, I guess some people are hosts. Okay. Okay, so 2 people, net profit after tax. You're correct. So for providers of equity capital, your return is coming from profit after tax or net income, or Gift Irabo said EAT, earnings after tax. Yeah. So your return is coming from either whichever way you want to call it, PAT, EAT, or net profit, right? That is where it's coming from. So if I'm going to calculate dividend coverage ratio, it will be profit after tax divided by the total dividend that is to be paid to the equity holders. So that's what dividend coverage ratio is. By how many times can PAT cover dividend that is being paid? For providers of debt capital, right? Okay, let me ask again. For providers of debt capital, from which item on the income statement will they be paid their return? Drop your answer in the chat box. Looking out for that. I think my advisor said a bit. Is it correct? Okay, Gives Irabo said a bit. So a bit. Okay, so correct. That's correct. And from the items, you can see interest expense, right? So basically, interest coverage ratio is EBIT divided by interest expense. But you can now decide to calculate other coverage ratios. Some people decide to say, oh, by how many times can EBITDA cover interest payments? And then they do EBITDA divided by interest expense. Some people even go to the extent of saying, oh, let's do dividend and interest coverage ratio. Let's add dividend and interest together. But how many times can EBIT cover interest and dividend payments? So the whole idea of coverage ratios is just to calculate how easy it is for a business to finance payment of return to providers of capital. So that ends everything on ratio analysis. I think we are doing fairly okay on time. We still have one more segment that I want to explain, some things on. We'll come to preparing a three-statement financial model, because I think that falls within the bandwidth of the curriculum I was given to address in this class. So we are going to come back to cover this segment, and I'll walk us through it. But let's go to Excel now. I slightly want to believe that we sort of have a rough copy, or we have historical financials of CAP typed in Excel, so that we can just go along together. Kindly confirm if you have CAP's historical financials in Excel. Kindly confirm in the chat box, please. Okay, if you don't, nobody is confirming, but if you don't have, just go along with me. I would change the screen I'm sharing shortly. Okay, can you see the Excel sheet? Please confirm you can see the Excel sheet. Okay, all right, thank you. Okay, so let me quickly do something, right? So in the last class before today, so we're going to quickly cover practicals for vertical analysis. I know I explained. Okay, let me just add so that I don't beat over old things, right? So please, do you understand vertical analysis and horizontal analysis of doing financial analysis? Do you understand those two concepts very well, so that I don't go over it again when you understand it? Kindly confirm. So last class we did vertical analysis and horizontal analysis. I explained, horizontal analysis is like common sizing. Vertical analysis is basically calculating growth ratios, and it can show you patterns that you need to observe. Maybe growth patterns, or decline patterns in any particular line item. I explained that we did. I think we did a few examples, like a little example using Seplat. So I want to confirm if we understand that concept, or if I need to go over it again before I go to ratio analysis. If there's no response, I will assume that we understand it, and I'll move to ratio analysis today, because we still have three statements financial model to quickly cover, even if we won't complete the entire. Okay, so I take that as a yes. Or you can go over it a little. Okay. So basically, only Tijani, Gift, and Akinkume are in this class. Every other person is basically absent. Okay. Okay, I'll go over it, right? So let's pick vertical analysis. The whole idea, I explained in the last class that, okay, let me just go back to that slide so that you can see. I explained in the last class that, okay, horizontal analysis is basically a time frame. It's basically a time frame thing. It's basically like you're measuring growth rates. So horizontal analysis is basically growth rates. You are trying to look at growth patterns. You're looking at revenue. How has revenue been growing, or how has it been declining? You're looking at cost of sales. You're looking at all those different items in the balance sheet. You're looking at growth rates. So horizontal analysis basically is focusing on growth rates, while vertical analysis is focusing on is more like common sizing. You right? It uses. So okay, let's just go to an example. So let's do horizontal analysis first, right? So horizontal analysis, this is what horizontal analysis is about. So I can type in a growth rate, or let me just say revenue growth. Oh, let me just do this, is fine. Right, so this is the growth rate. We want to calculate growth rate for revenue. Let me give that a different color, put it in italics. Yeah. So what horizontal analysis is doing is this. Look at it. basically calculating growth rate. So this is revenue in 2019 grew by 8%, right? That is what horizontal analysis is trying to look at. So it's straightforward, really. So it helps you to study growth trends. You can see that there's a sharp spike in revenue growth in 2021. You might want to investigate what is the reason behind that sharp spike. Same thing in 2022. There was also another, sharp spike in revenue. Horizontal analysis will help you to measure that. You can measure it in percentage terms like this, and you can measure it in absolute terms. So absolute terms in the sense by saying this minus this, instead of doing it in percentage terms, you can just measure it in absolute terms and you drag across, right? And this is also another way. So you can see that there was also a sharp growth. 2021, you can see revenue grew by about almost 5.5 billion. In 2022, grew by something similar, about 5 billion. So you might want to investigate these two numbers, and to understand what was the reason for this spike. Was there an increase in volume of paints that they sold, or did they increase prices? It's more likely that they increased prices in 2021 because of the general increase in cost environment in 2021. But, you do that investigation and you find out. So that's what horizontal analysis helps you do. It's not only just on revenue. You can do it on selling and distribution expenses. If you notice that there's a spike, you can do it on balance sheets. For example, you come under what is current lab? Okay, so this CAP is not really leveraged, so they don't have loans and borrowings like that. So they are loans. So, for example, if they have loans and borrowings, or let me just use another item. Okay, so you come to trade payables, you can see that there's a sudden spike. So horizontal analysis is you are calculating the growth rates of different line items to investigate trends and patterns. So you can notice a big jump in trade and other payables in 2021, 157% increase, right? That is something that is worth investigating. If there is no clue in the notes to the financial accounts when you look at the financial statement, for example, as an analyst, if you have a call with the company or you have a meeting with the executive management, it might be something you want to investigate. That what was the reason for this spike? Was it that one of the likely reasons is that in 2021 there was no FX there was no enough FX in the economy, so a lot of companies that import raw materials were having to owe their suppliers, right? And they were, because they had naira on their balance sheets, but they could not convert the naira to dollars to settle their dollar or their foreign obligations, outside the country. So their trade and other payables, kept rising. That is likely an explanation, because CAP is a manufacturing company. They likely import some of the components that they use, or maybe they pay royalties to AkzoNobel for some of the, because I think they pay royalties maybe per unit of what I don't know. They have their trade agreements because they produce some of AkzoNobel's products here in Nigeria. So they may have been owing AkzoNobel maybe some royalties and things like that. But if you look at the breakdown of this trade and other payables in their balance sheet, you have an idea which type of payables drove the increase. Because remember, there are different types of payables. There's trade payables that comes from the course of ordinary business of the company. There's payables that comes from maybe intercompany activities. Maybe they sold goods to UACN, or they sold goods to Premier Feeds. I think Premier Feeds is within that UACN group. Or they sold goods to livestock feeds. I think, okay, they own livestock feeds, not Premier Feeds. So maybe they sold goods to livestock feeds, and they've not, maybe they sold some paints to them to do a refurbishing on it, and then they've not received payments for it. That's intercompany payables, right? It will still be included in this. But what I'm just driving across is you can see a sudden spike in payables there, and you may likely want to investigate it. So that's about that. So that's horizontal analysis. Vertical analysis, on the other hand, is like common sizing. So let me explain. Let me just do an example here. Let me take this out. So what vertical analysis does is, let me copy. Sorry, let me just copy the framework of the income statement. So I'm just going to use the income statement as an example. Please follow along. If I lose you anywhere, please just drop a message in the chat box to clarify whatever you need clarification on, so that I can come back to that. I want to make sure we understand this properly. So what vertical analysis does is it picks an item as the baseline for the analysis. Usually in income statements, we pick revenue. In balance sheets, a lot of the times we pick total assets as the baseline. So what will typically happen is you just basically pick revenue in 2018 divided by, because we want to express all the different line items as a percentage of revenue. That is what vertical analysis is trying to measure. How selling and distribution expenses, what percentage of revenue is selling and distribution expenses? What percentage of revenue is cost of sales? So that's what vertical analysis is all about. So it will definitely start with revenue. So what percentage of revenue is revenue? Obviously, it will be 100%. So you pick that, and then I hope you've learned how to use absolute and relative referencing. It will make it easier for you when you're working on multiple sheets. So we'll lock cell. I want this to move across. I want you to focus on just revenue. So okay, we lock the numbers. We lock 3. Yeah, so we lock 3 so that we can move from C to D and the likes. But when we drag down, this will not move about. But I hope we've done that in Microsoft Excel class. So I drag this across. You can do it in percentage terms. You can do it in times. Whichever way it works for you. I mean, there's a way you can format it in times, but this is not Excel class. And then you basically drag down. So okay, so let me use absolute. So I use the absolute formula so that it will remove the negative number at the back. Again, I'm sure you would have learned that in Excel, but just put absolute. Basically, the whole idea is you can see we have minus 52, minus 53. I want to take out that negative number. So I drag it down, and then you see it takes out the negative number. So you can drag it down to gross profit. Just drag it down across, and then you take out any part that is 0. Take out any empty row. Again, there's another formula you can use to remove empty rows, but I mean, it's not Excel class. Let's just leave that. So this is what vertical analysis is about. That's what it's about. So it's saying in 2018, cost of sales was 52% of revenue. In 2019, it was 53%. In 2020, there was an increase in 57% to 57%, right? And then there was another increase. There was a jump, a big spike. So you can notice this is what vertical analysis is helping you to measure, right? There's a big jump to 68%. Something is fishy. That's almost 11%. And this is critical because it means the margin. It means before, in 2020, CAP, for every 100 naira they generated, they were getting 43 naira in gross profit. But in 2021, because of a big spike in their cost, for every 100 naira they were generating, only 32 naira was going to profit. And in the end, it would have a negative impact on their bottom line in the end. So you can see, I mean, there were other items here that would have likely impacted this, but you can see that net margin, profit after tax as a percentage of revenue declined to 8% in 2021. So for every 100 naira they generated in 2021, they only made 8 naira in profit. That's a decline of 6 naira per 100 naira of revenue. That is a huge concern. Meaning, if revenue in 2020 was the same thing as revenue in 2021, there'll have been a very big dive in profit. So you want to investigate what happened in 2021 that led to this. I know the likely reason, but you are an analyst. That's what you're doing for the self-research challenge. Make sure you investigate that. You can look at the effect on the income statement. In 2021, there was an increase in revenue from 8 billion from 8.7 billion to 14.2 billion. But profits, so revenue increased by about almost 5.5 billion. But profits increased by only 816 million. That is a problem. Meaning, despite increasing revenue by 5.5 billion, gross profit only increased by 816 million. That is a concern, a very big concern. So you want to investigate why did that happen? It is likely because of increase in cost due to, what happened in 2021. Naira lost value against the dollar. CAP has some dollar raw materials and things like that. So if an inflationary environment, cost of wages increased, cost of power increased, the cost of diesel went up, cost of gas went up, so all those things impacted. You can look at when you go to their cost of sales you can look at the notes to their accounts and you see the different reasons for that. So look at what has happened there. We used a combination of horizontal analysis. Remember, this is horizontal analysis. Yeah, this is horizontal analysis. So in absolute terms, subtracting, getting the absolute increase in revenue and the absolute increase in gross profit. So we used a combination of vertical and horizontal analysis here. We calculated, we noticed a big spike from year to year. Something must be wrong. We looked at it and then we investigated for that. As simple as these are simple tools, but simple but effective tools that would help you uncover a lot of things. These are just basic tools that you can combine together, that we uncover so many things. As me was a full-blown boot camp or something, we would have done a lot of, analysis and used several examples, and you'll have seen so many things. Well, I will still try to definitely cover a few things as we go, but from combining those two simple that you think are nothing, horizontal analysis and vertical analysis, you have been able to deduce something that happened in 2021. You apply this to so many other years. If you might, I think CAP's financials are available from as far back as 2013 or 2014. So when you are doing analysis, it's important for you to take into consideration the historical context. So make sure I just use 2018, 2020 because I'm just using an example in class. So you can get as far back as 2014. So that you look at the historical context, where is CAP coming from? If you look at, for example, if you're analyzing companies like Nigerian Breweries, Guinness, it gives you an historical context. You look at what Nigerian Breweries, their margins in 2010, 2011, 2012, 2013, and you see the sudden decline in the margins today. You're able to understand the history. You're able to say, oh, if there's a decline, what has driven this consistent decline in their margins over the years? And if there's a consistent decline in margins, it will be impacting on profitability. That you can see CAP here. In 2018, their profit was 2 billion. But in 2022, they are not doing any better. Just marginal improvements, 2.4 billion. And, if you go further to look at it in terms of earnings per share, we'll come to earnings per share and all those definitions later. That will be the final segment. You see that earnings per share just improved from 2.9 naira per share to 2.92. Why? Because they even had to raise more capital. They have to raise more capital, which led to an increase in the number of shares outstanding. So despite raising more capital, they are not returning more, they are not generating more returns to investors. Again, don't let this blur your assessment of CAP when you are doing your analysis. Do your analysis. This is just, I've not sat down to do any analysis on CAP in the past. So these are just things that I'm observing by explaining all these things to you in class. So, you can see how important it is because of the significant increase in cost. Look at how it has impacted profitability. So the company has barely grown in terms of profitability. And same thing applies to things like selling and distribution expenses, administrative expenses. There's a big spike in administrative expenses here. I'm sure that, if you go back to our vertical analysis, we see administrative expenses. There's a big spike here, 16 to 20%. It moderated the BTA, maybe because revenue grew significantly. So it moderated the BTA. But there was a big spike in 2020. Why was there that big spike? Oh, in 2020, there was COVID. There was a likelihood that the company had to provide special tools for people that are working in the factory so that they can practice safe distancing, for their staff. They had to pay more. They are maybe for keeping staff in their plants. They had to pay them, hazard allowance, or they have to take care of their feeding, so those are different expenses that, or, they did some special donations to different, during COVID and all the likes. So those are all things that could have impacted. So some of those items could have been one of which explained why there was a return back to normalcy here. But the whole idea is you use all these tools to analyze. Don't let me spend too much time on that. Let's go to ratio analysis. So at this point, I'm sure that we understand horizontal analysis and vertical analysis. Horizontal analysis, growth rates, either in absolute or relative terms. Vertical analysis uses common sizing. It picks an item in the income statement or in the balance sheet as the focal point and expresses every other item as a percentage of, the what's it called now, as a percentage of revenue or whatever item is picked as the basis for analysis. So ratio analysis. this is the second to the last thing we have to do today after ratio analysis. So ratio analysis, I'm not going to do all the ratios, right? I'm just going to do a few ones, and then we would quickly jump to three statements financial modeling, just to show us how to do forecasts and things like that. So let's go quickly to. So let's start with profitability ratios. Profitability ratios. So let's go together. Just follow me. If you have an Excel of the historicals of CAP, maybe you've typed that out already. You can just go along as we do this ratio. So I'll pick three ratios from each one, from each category, and then we'll do that together here. First, let me do this. Give me a minute. Copy this. Yeah. Okay. All right. So profitability ratios. So profitability ratios. Okay, let me just throw this. Which profitability ratio do you want me to cover? Which profitability ratio do you want me to cover? Just type in the comments in the chat box so that I can I will cover that in. So for profitability ratios, pick three ratios you want me to cover. For what's the other one? Efficiency ratios. So I will just pick it from the charts. Efficiency. How do they spell this thing again? Efficiency ratios. Then we'll do liquidity ratios. We'll do, because I'm trying to save time, so I can't cover everything. So liquidity ratios. What's the other? Solvency ratios, and then coverage ratios. I mean, coverage ratios are quite straightforward. I don't know if I should cover that, but let me just put that coverage ratios. Okay, so okay. So we have quite okay. ROC, return on capital employed. So you want us to do return on capital employed. Let me just type ROC so that I can save time. GPM, gross profit margin, I guess. Asset turnover, that's under efficiency ratios. ROE, ROIC. Okay, so ROC, I think someone mentioned gross profit margin. So gross margin, return on equity. So someone mentioned return on equity. Efficiency ratios, someone mentioned assets turnover. So I want to do those calculations that will lead me to cash conversion cycle so that you understand that's one. So I'll do asset turnover. I will do, let me see, receivable, let me see which other. So someone asks for return on assets. When we do return on equity, return on assets is very straightforward. But I would show that asset turnover. Let me do. So I want to lead up to calculating cash conversion cycle. I think I will spend more time on efficiency ratios so that let me give more space. So 2, 4, 5, 6. So asset turnover will do days of sales outstanding, days of sales outstanding. We do days of payables outstanding. We do days of inventory outstanding. Why is okay? Then we'll do cash conversion cycle. So, sorry, please, just 1 minute. Okay. Okay. Yeah, sorry. I think that's all on. Okay, let me put inventory turnover. Sorry, I had to respond to an urgent message. Inventory turnover. So then let me just put receivables turnover. So whatever I do for receivables turnover, it basically repeats for payables. Or let me just put it so that, because these are the ones that could be fairly confusing. Okay, so let's pick them. Okay, let's do this first. So return on capital employed. So okay, let me explain. So let me explain capital employed again, right? So I told you capital employed is basically the funds that are used to basically finance the operations of the business for that to generate that particular return that you're calculating for. So return on capital employed is now. Okay, so let's go back. Let me go back to the presentation. Let's go back to this slide, right? Remember, when we are saying capital employed includes both equity capital and debt capital, right? So when we want to calculate the return on capital employed, we will not use PAT. We are not going to use profit after tax, because profit after tax is only for equity holders. So when we are calculating return on capital employed, we use operating profit, or what we refer to as earnings before interest and tax in this slide here. So we use operating profit. Why? Because operating profit is attributable to both debt holders and equity holders. So that is what we use. So that is the numerator, operating profit. So what do we now divide it by? There are two iterations of the proper way, right, of the standard way of doing capital employed. This is according to CFA methodology, right? Because you are doing CFA research challenge, right? And CFA is a major authority in the finance world. So based on CFA methodology, in terms of the definition of capital employed, because like I mentioned, you might see definition of capital employed as something else elsewhere. But to calculate capital employed, all you basically need is your total assets. Remember, we are saying the capital that was used to finance the operations of the business to generate that return, right? So we basically take the total asset of the business minus current liabilities. Now, I will explain to you, okay, so let me use this other iteration, because this other iteration will help you understand it better. So apart from saying total assets minus current liabilities, you can also say non-current assets plus working capital. Now, let me explain it. Let's go back to our Excel. Now, there's something called working capital. You might not have heard of that before this class. So there's something called working capital. Working capital is basically current assets minus current liability. That's working capital, current assets minus current liability, right? So the whole idea is working capital is capital that you need to run the business on the go. So if you need to add more capital, so if your total current asset is maybe, if your total current asset that you need for next year is maybe 100 naira, and your total current liability is 50 naira, or let's say 60 naira, right? That there'll be distinction in the figures. 100 minus 60, your working capital is 40 naira. So that is extra capital that you need to add to run the business, right? So that is extra, because current assets are inventory that you need, the cash that you already have and everything. But to finance your current assets, that is your short-term assets, the short-term liabilities you have, maybe bank overdraft, to buy inventory, the people that you buy goods from on credit, that you tell them you will pay them back later, right? So those are ways you are financing your current assets. Your current assets are your short-term assets that are consumed within that particular year. So when you subtract it, whatever is left is basically, remember, if it's a positive figure, it means that you have more current assets than current liability. So that means you need that extra cash to finance the asset acquisition. So that is working capital. That's why it's referred to as capital. Now, to calculate capital employed, we say capital employed is fixed assets, or let me say non-current assets. That's using the current IFRS definition, non-current assets plus working capital. Now, from the definition of working capital I've given you, I said current assets minus current liability. So if you bring it into this formula, bring it into this working capital formula, you have, so I want to use short forms, mnemonics for this, NCA. So I'm going to use NCA for non-current assets. So you say non-current assets plus current assets minus current liabilities, right? So, and we know that non-current assets plus current assets is what? Is equal to total assets minus current liabilities. So you can either say capital employed is non-current assets plus working capital, or total assets minus current liabilities. So I'm typing this out so that you can understand what I'm saying. So, okay, I think there's a chart here. Sorry, you can't hear me? Can everyone hear me? Please just confirm in the chat box. Can you hear me? I can see Korede is using a mute. Okay, so everyone's saying they can hear me. So Korede, I guess maybe it's your network. You might need to look at that. Okay, so capital employed is basically, like I've said, capital that used to run the business for that period. So our non-current assets, obviously, we use it to finance, we use it to run the business for that period. Our PPE, our, non-current assets is usually made up of PPE most of the time, right? So our PPE, then our, what was it called now? Aralua, you might want to switch off your video. Then our working capital. So that is the capital employed in the business. So capital employed is non-current assets plus working capital. I know it might sound confusing because when you say capital employed is all the total capital in the whole business, but just understand that distinction. When you are talking about capital employed, simply remove your current liabilities from your total assets, basically. That is what capital employed is all about. Another way, don't let me give you another way. Let me just leave it at that so that I don't confuse you. There's another iteration of this formula that we still give. If you understand the dynamics of balance sheets, non-current assets, current assets, non-current liability, current liability, equity. If you understand the dynamics of all those items, you would know that there's another way you can iterate this formula again, but let me just leave it at that. So now, let's do some. So let's calculate our capital employed let me do it here. So capital employed, let's calculate our capital employed here. I'm just, because we're in class, we should actually have a proper ratios slide to, we are meant to have capital employed and all those net debts and all those different things, but they are not within the scope of what we are doing currently. So to calculate our capital employed for 2018, we basically go to our balance sheet, go to balance sheet. So for 2018, which method should we use? We can use total assets minus current liability. So we basically say total assets, that's 6.3 billion minus current liability. That is our capital employed, all right? So if you use the other iteration, use the other iteration, that is fixed assets or non-current assets plus working capital. We know working capital is current assets minus current liabilities. So if you decide to use that iteration, we'll have the same thing. I guess you understand at this point. So let me just leave that. So return on capital employed will now be operating profit. That's 2.285 billion, operating profit of 2018, divided by our capital employed for 2018. And you have So return on capital employed there is 78%. So you can just drag this across to 2022. That's the capital employed for all those years, and you drag this across, and this gives you capital employed. From this, what you observe is, oh, sorry, this should be here. Should be under return on capital employed. So what you observe here is that there is a steep decline in return on capital employed, right? And again, all these ratios you are doing, all these things are telling you that there is a problem within the paints, the chemical and allied paints industry. Something is wrong, right? So you want to investigate why are returns declining. So now this is not just a conclusive evidence on its own. You corroborate it with other evidences. Another evidence you can use to corroborate is return on equity. Return on equity is So return on equity this time around now is different from return on capital employed. Remember, equity this time around, we are talking about return to what? To shareholders. Now, quickly, like I mentioned, I said there's a difference between when a company has minority interests and when they don't have. CAP does not have minority interest, correct? So total equity, they don't have minority interest. But for some companies that have minority interest, you would have minority interest as part of after summing all these items together. You now have minority interest, and you have total equity and minority interest. So if you want to calculate the return on equity for a company that has minority interest, and you want to focus on just equity holders, you do profits attributable to. I wish I have models like that, but I can't. I didn't select them to share. I have to start looking for them. But them just like, but you pick profits attributable to holders of capital. So what you typically will see is when you have profit after tax here, you will now have minority interest under that is profits for minority interest. Then they will deduct it from this, and then you have the last figure here. So that figure is the profit attributable to owners of equity capital. So it is that figure you will now pick divided by the total equity before adding minority interest, right? So that is if there, but in this case, there's no minority interest. So return on equity is basically profit after tax divided by total equity, right? So let's do that. Profit after tax divided by total equity. I think okay. Yeah. So that's in percentage terms, 72%, and then you can drag across. Again, you are noticing another thing here. I mean, there are bits of rebound in 2022. So you want to see, will this rebound continue to 2023 when you are doing your forecast? Remember, this 2023 to 2027 are forecast years, your 5-year forecast years. But we'll come to that. So that's it. Gross margin, like I've said, is gross profits divided by revenue. So you just pick gross profits divided by revenue, and you drag across. So Sefini. So you can do the same thing for operating profits. You can do the same thing for let's do a small classwork. Everyone calculate the operating margin for 2019. Calculate the operating margin for 2019 and put your answer in the chat box. Just based on, I mean, this is the what was it called now? This is the income statement. So calculate your operating profit. Maybe use your calculator or open your Excel somewhere and just calculate it. Calculate your operating profits for 2019. I'm waiting for responses in the chat box. Waiting for responses in the chat box. Yeah, now please help me to manage this time. I have just about 40 minutes left. I want to make sure you at least have an understanding of the intuition behind the way these things work, please. Quickly. No response yet. This is 5 seconds. So Akikumi Adebayo said 25.2%. Okay. Another answer. Tomiwa said 29.42. Interesting. So we have to 25.32. I don't even know what the answer is myself, so I have to calculate it. So we have 3 answers. Okay, let's quickly calculate it, right? So for operating margin for 2019. Operating margin is what? Operating profit divided by revenue. So I take operating profit for 2019, 2.12 billion, divided by revenue. Oh, sorry, I've not put it close. So this divided by revenue, and what that gives you is 25.23. So okay, so that was okay. Tomiwa, you said that's for 2018. Let's confirm. Is that correct? So 2018 is about 29%. Okay, so that's correct. So I'm happy. I'm happy about that. That's good. So I guess we understand the way profitability ratios work then. So let's quickly jump to efficiency ratios. I'm sure we understand efficiency ratios. The rest are pretty straightforward. This is efficiency ratio is the most annoying part of doing ratios. So let me start with turnover. I want to start with the turnover ratios, then we'll come to these two, right? So okay, we have the turnover ratio, asset turnover. Now, remember what I told you. I said asset turnover is basically how efficiently a company is using its assets to generate revenue, right? So how efficiently is that company using assets to generate revenue? And the formula that we use to calculate asset turnover ratio is basically the total revenue or total sales divided by average total assets. There's a reason why we say average total assets. Let me explain to you the reason why. Remember, when you start, so at the beginning of 2023, when we start making revenue, when we start making money, we have assets from last year that we brought over to this year. And then there will be assets that we buy this year that we also use to generate revenue. So a lot of times we like to use an average of the two. Some people like to use capex. Some people will say capex for this year plus the total assets from last year. So the opening balance of total assets from last year, they will add it to their capex to calculate their turnover ratio. Some people do that, but advisable for you, because that's the generally accepted method. You use average assets. So what we need to do to calculate assets turnover, so let me just do it here. Average total assets. So I mean, average total assets is straightforward. So for 2018, unfortunately, we don't. So we can't. So for 2018, we will just use 2018 figure because we don't have 2017's, or we don't have 2017's opening total assets. So let's just use 2018's figure for 2018. But for 2019, we just do average of 2018. Oh, no, this total assets. Average of 2018 and 2019. So, and that's the figure you have. I think I made a mistake on this on 2018. 2018 should be this. Okay, this is total assets. So this is the average total assets, and you just drag across. It would pick for all the other years like that. So that's average total assets. So to calculate my asset turnover, I basically will say my 2018 revenue, 7.7 billion, divided by my average total assets. And then you drag across. So you can do this like this, or you can do something like this. You want to put it in times, you can just do something like this. Yeah, and you can have it in times like this. So asset turnover was 1.2 times, or let me make it 2 decimal places. 1.23, 1.29, 1.14, 1.38, 1.51. That was the asset turnover for each of these years. Now, how do you use it? From here, you can notice there's a drop in asset turnover, right? I mean, these 2 years, not so much of a difference, but there was a bit of a drop here. And what this tells me is efficiency reduced. Asset usage, asset efficiency reduced here. So there was a problem. They didn't generate enough revenue for the assets that they had. But there was an improvement here, and then there was an improvement in 2022. So you can see that revenue has increased. So, and if you notice, you see that there's an increase in revenue, 19.2 billion, relative to what it used to be, 8.7 billion, 8.4 billion. So when you are comparing it to total assets, you can see that total assets is still within a similar band, is increasing by a similar amount. It's increased by about 2 billion here, 4 billion here, and then 1 billion here. Whereas revenue recorded a big jump, I think this more than doubled, or okay, almost okay, about 70% increase here. So you can observe the significant jump. But again, another question you have to ask is, yes, there's an increase in assets turnover in 2021 and 2022, which indicates that the company is efficient in using its assets to generate revenue. But the question you have to ask yourself is, that increase in revenue, where is it coming from? Is it coming from producing more paints and selling more paints? Or is it coming from an increase in price? So there are two different things, right? Because a company can see asset turnover improve significantly, but the improvement in asset turnover is not coming from you sweating that asset more. It's coming from you increasing your price. And either way, yes, it's still to the benefit of the company, but it's just important for you to understand it does not necessarily mean that the company is producing more or making more efficient use of its assets, produce more paints. Rather, it has generated the increase in revenue from price increase. So that may be the case in here, but I leave that to you to go and find out. There's a chat message in chat. Okay, just relating to the last question. Okay, so that is assets turnover. I'm going to calculate inventory turnover. So I'll calculate inventory turnover. I now want you guys to do receivables turnover for me. When I finish inventory turnover, I want you to do receivables turnover for me. So I want to see if you understand this. So for inventory turnover, similar to assets turnover, inventory turnover is basically like, and remember I mentioned for inventory, we look at it from a cost perspective, not from the revenue perspective. Now, there are some formulas that look at it from the revenue perspective, guaranteed. Actually, there are formulas like that. So what they do is they do total revenue divided by total inventory measured at selling price. So some companies, some analysis, you see, you read some papers or some things, they actually do that. What they do is, instead of measuring their inventory at cost, they measure their inventory at selling price. So if you measure your inventory at selling price, you can say total revenue divided by average inventory at selling price. But if you are using cost, you say cost of goods sold divided by average inventory. By default, inventory is usually measured in cost. That is cost of on cost basis, cost of buying the inventory, right? But if you are preparing for an exam now, something I'll tell you to be wary of. Some questions they will put it that inventory value measured at selling price is so amounts, and then they will tell you to calculate the inventory turnover. It's usually traps that examiners set in exams, but you are doing practical business challenge here. But you can also be on the lookout for this, in the sense that if you read the accounting policies, when you go to the notes to the accounts of some companies, there just might be a chance that there's a particular company that measures inventory at selling price. Not all companies measure some companies may not measure at cost, they may measure their inventory at selling price. So you might want to be careful about that. If you look at the notes to the account and you see that they measure based on selling price, then it means we are calculating inventory turnover. You don't want to use cost of goods, so you use total revenue. So, but in this case, I want to believe that CAP uses cost basis for their inventory. So what I need to do is I need to get my average inventory, right? So for my average inventory for 2018, you remember we are going to use, since we don't have 2017 figures, we'll just use the same thing for 2018. But for 2019, we go average divided average of 2018 and 2019. And that gives us this, and we drag across. And then this is our average inventory. So we now do, so for inventory turnover, we do cost of goods sold divided by average inventory. So it will give you a negative figure, but you look at the figure in positive terms. So even if, because the reason why it has a negative figure is because cost of goods sold is a negative. So to remove the negative, I'm going to put the absolute function in front and get it this way. Then I want it in times, and I drag across. This is my inventory turnover. So now, so let me explain receivables turnover to you. Now, receivables turnover, ideally, the formula for receivables turnover is total credit sales. Note that total credit sales divided by average receivables. So you can see the similarity in turnovers. Assets turnover is total revenue divided by total assets. Receivables turnover is total. The reason why we're using total credit sales is because your denominator is focusing on people that owe you. That is total receivables. So if you are calculating receivables turnover, you are to use total credit sales divided by receivables. However, it is difficult for you to know from looking at the financial statement. It's difficult for you to know what portion of revenue for that year was sold on credit, unless maybe the company discloses it and stuff like that. So it might be difficult for you to know. So what we typically do is we just use total revenue divided by average receivables. So that's what we just typically do. Just use total revenue divided by average receivables, but it doesn't really give you that accurate answer that you want, because the ideal method is total credit sales divided by receivables, divided by average receivables. And I guess from that formula of receivables turnover, you have an idea what payables turnover is. So I want you to calculate payables turnover for me now. Drop your answer in the chat box, 30 seconds. Calculate payables turnover for 2018 and give me your answer in the chat box while I calculate for receivables turnover here. So calculate for 2018. I'm waiting for my answers. We'll calculate it together here. So I'm waiting for my payables. Intuition, just use the intuition. Use the intuition of what I've explained so far on turnover. Use the intuition. I'm waiting for my answers. Okay, I can see one in the chat box. Oh, okay. Balance sheets. You don't have the... Okay. So this is the balance sheet. This is... Okay, no. Let me just... I just leave it like this. So I won't tell you. So you can write out the balance sheet figure. So for 2018, write out the figure you need for 2018. And then the figure for... If you need any figure in the income statement, let me know. Okay, you need income statement. So you've taken the figure you need from balance sheet. So this is the income statement. No answers yet. This thing is 10 seconds. So for 2018, remember, we don't have 2017. So instead of calculating average, just pick the singular figure, pick the other item from income statement, divide it. That's all. We have a four. Okay. Akim Adebayo says 38.6 times. Okay, keep it coming. Let's get two more answers. If you need me to open any of the state components of the financial statement again, let me know. $38.6 from oh yeah, time is going. No, time is going. I have they won't chase me away now. Let's except if you give me permission to continue after 6:10. Yeah, now give me one more answer. Daniel Caleb, you asked for income statements, so you should be. Tomiwa Kingbade, you gave me an answer the last time. Temilade, Rodiat. Oh yeah, now, oh yeah. This thing is not hard. Trust me. It's intuitive. If you don't, if you are not able to calculate this, like literally, I get the fear that you don't yet totally understand the intuition behind this. Although with experience you build it, but just look at the concept of receivables turnover. Apply it to payables turnover. Simple. Okay, in the interest of time, I'll just go ahead to calculate because, okay, please, let me, so if you didn't get the answer, right, please put it in the chat box that, just put, I don't understand. Put it in the chat box, please, so that I can explain it. Put it in the chat box that I don't understand. So either you put your answer or you put, I don't understand. Oh yeah, I want responses. No response. Rodiat left. Why is Rodiat leaving? Tomowa said he does not understand. Okay. Okay, let's just take it again. All right. So now remember the concept of receivables turnover. Receivables turnover is people that are owing us as a company, people that are owing CAP. Let's say we are CAP. People are owing us. We want to look at how quickly we are able to, how quickly we get our money back. Right. So that's receivables turnover. And to calculate receivables turnover, we said it is basically credit sales divided by average receivables. Payables turnover is people we are owing. So that's credit purchases divided by average payables. What is your purchases? Your purchase is referring to your cost of goods sold. Simple. So the ideal calculation is what component of this cost of goods sold is on credit. But unfortunately, we don't have that. So in calculating this, all you need to do is to take cost of goods sold divided by average, what's it called now? Average payables. Simple. That's the whole idea behind it. So let's calculate it. Please, do you understand that explanation? No, it's not. Okay, Tomiwa, yes. Korede, Temilade, yes. Okay. Okay. So that's just it. Isn't like, trust me, you don't need to just understand what these things, just don't worry. Over time you build the experience. So let's just calculate it here so that we'll see if the people that give us answers are correct. So we'll come to trade and other payables. This is it. Yeah. I calculate average for the rest of the years. So average. Okay, so we come here, payables turnover will now be cost of goods sold or cost of sales divided by average payables. Okay, because cost of goods is negative, I put absolute in front and I have 2.58. That's my answer for 2018. So this is payables turnover. So if I go Danny Caleb 2.58, Akinkumi said 2.58. Oh, okay, you corrected yourself. 2.5. Okay, you said 38.6 before. Okay. Okay. So that's payables turnover. So let's quickly do days of sales outstanding, days of payables outstanding, and days of inventory outstanding. These three items are both linked, not both, sorry, are all linked to their respective turnover ratios. Days of sales outstanding is related to payables turnover. Days of payables outstanding is related to payables turnover. Days of inventory outstanding is related to inventory turnover. In fact, if you have these three, you can calculate these three. If you have these three, we can calculate these three. Let's see how. All the days of whatever outstanding is basically 365 divided by the turnover ratio. That is, you want to get it in days now. So days, remember, days of sales outstanding, days of payable outstanding. So days of sales outstanding is basically 365 days divided by what is receivables turnover. Stephanie. So let's format this a bit, change this to days. So days of sales outstanding is 8 days in 2018, and you simply drag across. So that's days of sales outstanding. So what this tells us is in 2018, no, maximum that CAP gave the people that were owing them was 8 days. Literally, like it was almost cash and carry, basically, like literally almost cash and carry, you know. So days of payable outstanding is same thing, 365 days divided by payables turnover. Now, let me quickly explain something. Please indicate if you understand what I'm doing. Just say yes. Just say yes, yes, yes. If you understand what I just explained, okay, 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 good. So now imagine we had days of sales outstanding and we didn't have inventory turnover. This is just for knowledge sake. If you have days of sales outstanding and you don't have inventory turnover, if you want to calculate, and you don't have receivables turnover, if you want to calculate receivable turnover, what do you do? Can someone guess in the chat? Can someone guess? If I gave you days of sales outstanding and I told you calculate receivables turnover from the days of sales outstanding I gave you. So if days of sales outstanding is 8 days in 2018, how do you calculate receivables turnover? Don't give me the figure. Tell me how to calculate it. Correct. I shout at the gun. That's correct. So 365 days, 365 divided by days of sales outstanding. So perfect. I think we understand that. So don't let me spend too much time. Let me just go straight and calculate days of inventory outstanding. 365 divided by this, and we have this. So format and interest. So cash conversion cycle, like I said before, cash conversion cycle is basically days of sales outstanding plus days of inventory outstanding minus days of payables outstanding. Now, in this case, either you have negative or positive answer, or you leave it alone, because negative or positive, it has its interpretation. So let's calculate. days of sales outstanding plus days of inventory outstanding minus days of payables outstanding. We have minus 53 days. Now, the reason why we have minus 53 days is because CAP takes a long time to pay their creditors. So they have good credit terms with their creditors. So roughly around 140. In fact, you can see the almost near consistency: 141 days, 138 days, 146 days, 149 days, 142 days. So that's, they have roughly maybe a 140 day, or let me say 150 day arrangement with their creditors to pay from looking at this, right? So they take a long time to pay their creditors, but if you are owing them money like this, they are hounding you: pay my money back, pay my money back. So the reason why it is negative, so for it being negative, it means that they are able to quickly convert their inventory or their products to cash. They are able to generate cash quickly. So they are very solid in generating cash. That is why this is negative. Assuming it's positive, so assuming maybe days of payable outstanding was maybe, say, this is 88. Let's say this was 38 days. Let's say days of payable outstanding was 38 days. It means this will be 50 days, right? It means cash conversion cycle will be 50 days. It will mean that it takes them 50 days to convert inventory to revenue, or to cash. Sorry, not to revenue. Sorry, not to revenue. Revenue can be credit or cash. Sorry. It takes them. So assuming, so let's change this to 38 days. We'll have 50 days. So if you have positive 50, what it means is it takes CAP 50 days from the day it brings in inventory to the day it receives cash for the sale of that inventory. It takes it 50 days to convert its inventory to cash. That is what cash conversion cycle measures. But because this is negative, literally it means CAP is generating cash by they generate cash in less than 1 day. Like, they don't even need a day to generate cash. You understand? And the reason why it doesn't even take them that is because, number one, they get their money from their customers fast, literally almost on a pay cash and carry basis from their days of sales outstanding. And then they take time to pay their suppliers. And you can understand this from the business model of CAP. CAP supplies large distributor. I mean, let me just leave that. Do the research yourself. Please put in the chat box okay, let me do it this way. If you don't understand my explanation of cash conversion cycle, please indicate in the chat box. Just indicate if you don't understand. So if no one indicates in the next 30 seconds, I will assume we all understand. So I can drag this across. Okay, appears everybody understands. So, okay, let's move on. So you can see cash conversion cycle in 2022 was 38 days. That was 38 days. So it took them 38 days, and that was largely because of it took them more time. Their inventory outstanding, days of inventory outstanding was very high. So that's so yeah, that's on that. And so let me quickly even show you something. Just so if you see that, you can see that they generate cash very fast, right? Even for 38 days, it's still pretty decent, right? So they're able to generate cash very fast. This negative you have is exceptional. Not all companies have negative cash conversion cycle. Most companies have positive. So this is like exceptional. So they are very liquid. So if from this you see this, it automatically tells you that this company will be carrying a lot of cash on they are likely going to be carrying a lot of cash on their balance sheets, because it means they are generating a lot of cash. So if I go to their sorry, no, not balance sheets. Okay, so if I come to here, I can see cash is about 4.3 billion. See total assets 6.3 billion. See, cash is a huge chunk of their total assets. Cash is about 69% of their total assets. Was 69% here, 64%, 67%, and then suddenly is now 21%, largely again because of dynamics of working capital, which reflects in this ratio analysis. Suddenly there's a drop in their cash conversion cycle. Yeah, there's a significant drop here, there's a significant drop here, and suddenly the percentage of cash of their total assets declined significantly. So that tells you already, the moment you are seeing a company have very interesting cash conversion cycle, negative cash conversion cycle, that tells you that cash is a significant portion of their total assets. That's just, again, another way of interpreting data. Can you have access to this Excel file? I think the organizers, I'm happy to share that, but depends on the CFA team, because the ideal thing is for you to actually build your own model, if I'm correct. So, but I think they will confirm if you can have the file, but I'm happy to send it to you. I'm happy to send it to you if they would allow that. So so that's ratio analysis. So I think so. Please, am I permitted to move straight to restatement financial model? You go and try calculation of liquidity ratio, solvency ratio, and coverage ratios yourself. Please indicate should we leave that, or okay, let me just quickly do. So let's do current ratio. Let's do current ratio and quick ratio quickly. Again, this is straightforward. Sorry. Current ratio, current assets divided by current liability. All you need to do is to just come here and say, where's my total current assets? Total current assets divided by total current liability. Stephanie. Boom. Quick ratio is, remember, quick ratio is current asset minus inventory divided by current liabilities. Boom. Stephanie. Once you have a figure above 1 times, ideally around maybe 1.5 times would typically be ideal, right? Once you have a figure above 1.5 times for current ratio, then the company is in a good state in terms of liquidity. For current ratio, so let me just put this here, greater than 1.5 times. Here we have greater than 1 times, company is likely in a good state. So really, so basically, that's just general rule of thumb regarding this. So there's a question from my chat. Why do we have to take the average of both assets and inventory for asset turnover calculation and inventory turnover calculation? So the reason why you have to do that is because, so for example, for inventory, right? There are some inventory for, let's say 2024 now. There are some inventory that will bring over from 2023 that we will sell in 2024. And there are some inventory that we will buy or produce in 2024 that we will carry to 2025. So not all the inventory in 2024 is sold. And not all that was sold in 2024 was 2024 inventory. If you get what I'm trying to say. So some were from 2023 and some of 2024 production will go to 2025. So as just a rule of thumb to calculate our inventory turnover or receivables turnover or anything, we just take an average of the opening inventory balance, that is opening inventory balance of 2024. Opening inventory balance of 2024 is the closing inventory balance of 2022. Of 2023, right? So we take the average of the closing inventory balance of 2023 and the closing inventory balance of 2024. We just take an average of that and we get the figure. So yes, just 2 average, just average of, so if you are calculating for 2024, is average of 2023 and 2024. If you are calculating for 2022, it's 2021 and 2022. If you are calculating for 2020, it's 2019 and 2020, basically. Yeah. Okay. So that's actually going to leave ratio analysis now. I'm sure you get the idea. Solvency ratio, debt to equity is debt divided by equity, debt to assets, total assets is debt divided by total assets, So I don't want to, I want to save time and quickly move to the next thing. The last thing on the list for today is this. Yes, building a 3-step financial model. So now, one of the key things in financial analysis, okay, let me just ask generally, are you enjoying the class? Just say yes or no. Are you enjoying the class? so that I'll know if I should tweak something. Okay, Aishat is enjoying the class. Okay. Okay, that's great. So let's do this, right? Let's do the last thing, right? Just permit me to till 6:30, please. Let me see if I can finish it by 6:30. So let's quickly look at three-statement financial model. Ideally, if I'm going to teach you three-statement financial model, it's like a 2, 3, 4 hour class on its own, like fully. But we won't have the time for that, and you need to. I'll just give you the key things that you need to know, and then from the materials I shared with you, you can use those materials to also supplement your knowledge. So, but let's quickly get into it. So let's go back to this balance sheet. I mean, sorry, it's a balance sheet. So this model, financial model. These are historical historical financials of CAP. So the first thing, whenever you want to build a three-statement financial model, is to enter the historical numbers. Now, people will tell you they recommend 5-year historicals. That's fine. But for me, I always advise as many years as you can get. If you can get the financials of the company from the day they listed on the stock exchange, even if they have their financials even before they listed on the stock exchange, get as many as you can that can cover like 10 years. The reason is you are able, it's always important for you to analyze the historical perspective of the company. Have an historical perspective of the company you're analyzing, because if you are going to forecast, you need to know where the company is coming from. If you don't know where the company is coming from, how will you know where the company is going? You know, it's just like you just come to them and say you want to analyze Tesla, and then you just pick the latest story that in Q4 2024, Tesla made record deliveries of Tesla cars in Q4 2023. And as a result of that, you just start projecting that Tesla will continue to grow vehicle deliveries forever, for the next maybe 5 years or 6 years, whatever period you're forecasting. Whereas that is not the truth. Tesla has had ups and downs. There have been periods where their vehicle deliveries declined. There have been times where they've had to make recalls from the market, you know, and things like that. So what I'm saying is, try as much as going to get, you know, if you can get from maybe 2013, 2012 CAP financials and enter your historicals. That's the first thing you need to do. Please make sure the figures are correct. You know, make sure you can ensure that you check the profit after tax, check everything, wherever you are something to make sure they are correct. So that's the first thing, like I put here. The first thing is input historical financial information into Excel. That is the first thing you need to do. So you do that for income statements, balance sheets, and cash flow statements. You input everything into Excel. So that's the first stage of building a three-statement financial model. Now, remember, the whole idea of this is you want to see if the prospects of CAP as a business is good, so that you can recommend maybe investors should invest or maybe they should not invest, right? So you need to forecast. You need to forecast what the company's potential would be. You know, what will revenue be like? What will cost be like? What will profitability be like? You know, and things like that. You need to make that forecast. So ideally, it's always advisable for you to at least do a 5-year forecast. You know, because when you are doing valuation, I'm sure you will have either you have done a class of valuation already, or you are going to do it in the future. I'm not sure, but in valuation, they will have taught you discounted cash flow valuation, using free cash flow to equity, you know, calculating your work. Basically, the whole idea is you want to value CAP and say, this is the price we think CAP is worth. So if you build your model, so you have to project, you know, what will revenue be like, because all these things would serve as inputs into your valuation. That is the whole idea of building a three-statement financial model in this case. Now, there are so many reasons for building a three-statement financial model. You know, when maybe a company is budgeting, trying to, let me just look at, focus on what matters to you. You know, you are building a three-statement financial model because the inputs from your three-statement financial model, from your income statements, from your balance sheets, from your cash flow statements, all those items will go into your valuation model or your valuation of CAP. So when you do your valuation of CAP, maybe you arrive at a fair intrinsic value of maybe 30 naira per share. So you believe oh, given the prospects of CAPA, I'm expecting consumer income to increase over the next few years. The president, the Tinubu administration is looking at achieving a $1 trillion economy. I think that is good. I mean, I'm not saying all these things are going to have factual or they are true. I'm just, random example. If the economy, if they're able to achieve the 1 trillion, economy in like the next 10 years, that will lead to development of more real estate. People will begin to paint more houses, so there'll be more demand for CAP products. People will buy Deluxe, people will buy Santex, and all the likes. And by the time people are buying all those products, that will be increased revenue. And if the revenue is increasing, then what do you expect for cost? Oh, for cost, we expect them to, they are currently working on a new technology that if that technology comes to fruition, it will help them produce more paints per hour, and as a result, they are going to be able to produce more paints, at a lower cost per unit, because before that they used to produce maybe 100 buckets of paint a day. If this technology comes on board, they'll be able to produce 200 buckets of paint a day, and it means they're able to, and by the time, so those are just examples, or maybe it might be the negative, union, there may be people that work in the paint industry may begin to form a union, and by forming a union, they may begin to push for higher wages, better conditions, work conditions, and things like that. And by demanding for that, if CAP is going to succumb to those demands, it means that their cost is likely going to increase, right? So I'm just giving you examples. These are factual. It's not just about numbers. So please, just, this financial modeling, basically, right? Financial modeling is representing real life situation in numbers. So you are looking at real life occurrences and how they impact all these things. So that is what you are forecasting. So make sure you read wide. Read about the paint industry in Nigeria. Read about the chemical industry in Nigeria. What is driving the industry? Look at, how is the industry growing? How is the industry grown historically? What has driven it? You look at, for example, look at the sharp growth rates that we had in revenue here. Look at, we had a sharp 63%, 35%, whereas revenue has been going at 4%, 8% before. Why this sharp increase? What drove it? Is it increase in price or is it increase in volume? So those are investigations you need to do. That is why that is what makes you an analyst. Being able to break down the numbers. Analysis is you break it down to the minute, to the minutia. You break it down as small as possible. You understand the underlying drivers. And when you understand the underlying drivers, it will help you to be able to project. So these underlying drivers, how will they change? That's where we'll come to the next line of building a three-dimensional financial model. Determine the assumptions that will drive the forecast. So typically, this is not a full-fledged financial modeling class. Let me just mention that I'm just meant to give you a rough idea of how to go about it, because if we are going to do a full-fledged financial modeling class, that is an entire different class or segment on its own. So we can't go into the full depth of it. But what I typically like to do, right, is I like to have my income statement assumptions. So I have my income statement assumptions here. Then I have my working capital drivers. I will explain what all these things mean. In fact, sometimes, right, if the company has, if I'm able to build an elaborate model for forecasting revenue for a company, I typically like to even have a revenue model separately. I like to have a revenue model separately. It's just painful that I can't really go into full depths of these things, but please just go along with me and pick the ideas and supplement it with the materials I sent to you, and then think freely, think intuitively, think, people say out of the box, and all. There's no box. Just think, when you are doing all these projections, just look at it, look at the income statements, look at the notes to the accounts, if you can see the breakdown. I will explain, I will try and do some examples. Let me just, try and see. So we are on the second step, right? Determine the assumptions that will drive your forecast. So the first thing is revenue. Usually, when you are building your financial model, the first thing you want to forecast is revenue, because literally every other thing in your income statement will be as a percentage of your revenue, basically, right? So you want to forecast revenue. That's the big thing. Now, I don't know how much disclosure CAP does, right? But for example, companies like, say, Seplat, for example, in the oil and gas space, they disclose how much crude oil they produce during the period. They disclose their average realizable price. They tell you the crude oil they produced from each oil block or each oil field that they have. They tell you the average price that they realized. They tell you their reconciliation losses. They tell you their deferment losses, and all those things like that. They tell you their uptime, their downtime, and you're able to use that to because see, this is the intuition. Okay, let me start it this way. Whenever you are forecasting revenue, look at what type of business the company is doing. So if the company engages in selling commodities or selling items, basically, most likely their revenue model is price times quantity. Simple. So in the case of CAP, they sell paint. So if you are calculating CAP's revenue or you are forecasting their revenue, all you need to do is to forecast price and forecast volume. Price times volume will give you revenue, right? So, like I was using the example of Seplat. If I want to forecast volume, Seplat will tell you their volume per day, their crude oil production per day, working interest production per day. They will tell you their uptime. So maybe in 365 days in the year, their uptime was 80%. It means 80% of 365 days, maybe that would be around maybe roughly 10, 36, 72. That would be around 280, between 280 290 days, thereabouts. So it means that they produced on about, let's just say, 290 days out of the 365 days in the year. So it means if I get the amount they produce per day, maybe they produced, say, 50,000 barrels of oil and gas per day, converted. Their total production for the year will be 50,000 barrels times 290 days. That will tell me the number of barrels they produced for the year. And then I can now get their price. So you can just, I can get their price and then multiply price times volume. So if you are forecasting, you can forecast that, they are putting measures like this to curb oil thefts, to do this, to do that. So their uptime will increase. They are buying a field or they are buying a particular asset. So their production per day will increase to this amount and then it will stabilize. If the asset is, there are so many nuances around all these things. So you have to know the business you are forecasting for. In the case of oil and gas, sometimes a company may have assets that are declining. For example, a lot of the oil fields in Nigeria are declining assets. So naturally, over the years, production per day will decline for a lot of assets in Nigeria unless you are able to drill significant amount of wells to arrest the declines. So those are just nuances around forecasting. But should you not account for products? Should not account for the products not so that of supply. Okay, so the example I was giving of Seplat, right? Most times all they produce is sold, most times. In some cases, they overlift, maybe on a quarterly basis, but at the end of the year, everything will be reconciled, such that at the end of the year, what they produce is what they sold, right? So the reason is because as they are producing, is going through the pipeline, that's the case of Seplat. In the case of a company like CAP, they may produce paints this year and then they didn't sell all. So okay, a perfect example is Okomo Oil. Okomo Oil used to give a lot of disclosures also. So Okomo Oil will tell you how much they produced per hectare of land, because they are an oil palm company. They will tell you how much they produce per hectare of land. They will tell you how much of it they sold. So you can do a sales to production ratio. So if sales to production ratio is 90%, it means that typically the company sells 90% of what they produce in a year. So when you forecast production for future years, you can just assume that 90% of that production will be sold, right? And that's how you do that. So that way, you'll be able to say, oh, this is the amount that was sold and this is the amount that was not sold. And that amount that was not sold will go into your inventory. So that is using those examples. Now, coming to CAP. CAP does not disclose a lot. Trust, I think they break down their revenue by maybe paints and then other chemicals or something like that. So they don't disclose, how many units, how many buckets of paints they sold, or how many liters of paints they sold, and then the price they sell. So this is where you now have to use the most sensible proxies to gauge your growth. So if you are doing forecasts, for example, what I can do is I go and download the GDP reports from MBS websites, and then I go to their industry, chemical and allied paints industry, or paints. I mean, there will be, I'm sure there will be a segment for paints and chemicals under manufacturing or industry in the GDP reports. So all I'm going to do is I go to the GDP reports, right? I look at real GDP growth and I look at nominal GDP growth. Real GDP growth basically measures growth in volume. Nominal GDP measures growth in volume and growth in price, right? So I'm just explaining this. This is someone asked me that question and I'm answering off the cuff, right? That's how you think as an analyst. You look at it that if I can't get the full details of what I need from the company, can I get it from a third-party source? If it's not available from a third-party source, can I get proxies? And the good proxy is usually GDP growth. So I look at real GDP growth. Real GDP growth will tell me growth in volumes. Nominal GDP growth will tell me growth in volumes and growth in price. So since I have growth in volume, so let me give you an example. Let me help you. I'm sure some of you here probably have knowledge of this matter. So if I pick, say, 2022, for example, and then by the time I check NBS financial statement, assuming we had time, we'll have built a full CAP model, but you need to build the model yourself. So I don't have enough time to build a full model here in this class. So let's say when we go to the MBS GDP reports, you can just type National Bureau of Statistics in your Google Chrome, click on it, go to the library, and it will bring out. Just search in the search bar, put gross domestic product, to bring out all the GDP reports, and then you can download for each of the years, So if real GDP growth in 2022 was 2%, for example, right? And nominal GDP growth was maybe 8%. Automatically, what I'm seeing is volume growth in this industry. This industry, total volume within the paints and chemical industry increased by 2%. Total growth. So this is total volume growth. Remember, real GDP is what? Total volume growth. Nominal GDP is both volume growth and price growth. It has incorporated it into it. So I want to strip out the price growth. So what you can do is, this is total growth. Use algebra. Total growth 1.08. So this is 8%. So 1 plus 0.08. That's what we have here. And then volume growth is 2%. So 1.02. So if I want to get price growth, all I need to do is, I know price growth times volume growth minus 1 will give me the nominal GDP growth. I don't know. I'm scared that you don't understand what I'm saying. Hey God. Are you following me? Please, can you confirm if you understand what I'm saying? Chat box. Okay, Temilade said yes. I need more. Daniel said he's lost. Tomola said he's with me. I said no. Aisha, okay. Okay. This is sometimes the disadvantage of one-on-one class. Okay. So let me take that. Let me take a step back and explain again. So the problem we have with CAP is that CAP does not have a lot of disclosure on their revenue. So they don't tell us the quantity they sold and the price at which they sold. So it's difficult for us to make forecasts. It's difficult for us to make projections into the future. So I'm saying what we want to do is we want to extrapolate. So remember, we said CAP CAP's revenue model is basically price times quantity. That is the quantity of paint they sell times the price they sell per liter. So if we are able to get their price growth and their quantity growth, by the time we multiply price times quantity growth, it will give us total revenue growth. Do you understand to that point? Do you understand? So please confirm. Do you understand to that point? Again, chat box. Do you understand to that point? Price growth times quantity growth will give me total revenue growth. Okay, so you understand to that point. So I'm saying we need a proxy for price growth and we need a proxy for quantity growth, right? The best scientifically driven data that you can get is to get the data for the industry. So if you don't have CAP's price growth and volume growth, I can get the price growth and volume growth for the entire industry. Are you with me? Are you with me? Yes, yes, okay. So now what we want to do is we want to get adequate proxies for price growth and for volume growth. So if we can get an adequate proxy for each of those two items, when we multiply the two, we have total revenue growth. So I now said, let us get for the industry. Where can we get the growth data for the industry? GDP reports. GDP reports can be gotten from the National Bureau of Statistics. So you simply go to the National Bureau of Statistics, download historical GDP reports for all the previous years you are looking into, maybe from 2013 to 2022, whichever number of years, right? You download it. MBS will provide you, so this is economics. MBS will, oh, okay, sorry, I forgot it. Some of you probably don't know economics. That's why you are sort of confused. Okay, so when you download the GDP reports, you would see real GDP and nominal GDP. Real GDP measures growth in, basically measures growth in volume. That is growth in actual goods and services produced, not the price. Because you know it can be deceptive. The volume sold can be declining, whereas the company is just increasing price. As a result of the increase in price, revenue is growing, whereas volume is actually declining. So that is why we need to see real GDP will tell us growth in volume or if there is decline in volume. Nominal GDP measures growth in the industry as a whole, price and quantity. Nominal GDP is basically revenue growth. This time around is revenue growth for the entire industry. That's nominal GDP. Nominal GDP focuses on price and quantity. So nominal GDP is already P times Q, while real GDP is just Q. So we want to extrapolate from those two items to get what growth rate for P, that's price. We want to get what the growth rate for price is going to be. So that is what we want to do. So if we're able to get growth rate for price and growth rate for quantity, we can multiply the two and get revenue growth. And then it should give us an idea of how the industry has been growing over the years. So now, once we get that, I will go to the next step, but let's extrapolate this first. I will go to the next step. So I want to confirm if you understand to this point. You understand the nuance around real GDP and nominal GDP and how it relates to price and quantity. Please confirm in the chat box. Okay. Okay, so I have 2 yeses, 3. Okay, so I'm good on that. So now let's go back. Remember, this 8% is a growth rate, right? So if 8% is growth rate for the year, so if I want to calculate if I'm going to do any extrapolation, I need to convert this to decimal place. So this is 0.08. But remember, it's just a growth rate, so I need to add it to 1. This one is mathematics. I don't know how to explain the mathematics. This is maths. This is the maths part. But so we do 1.0. We have 1.08 and 1.02. Remember, this is P and Q, and this is Q. So this is total growth. This is price growth. Now we want to get, this is quantity growth, and we want to get price growth. Now, That is what we want to get. So there is a way we can extrapolate this using algebra. Basically, all you need to do is, because Q times P is what will give you PQ. When you do PQ divided by Q, you will have P. Abi? Please, I need to be asking at each point so that I don't lose anybody at any point. PQ times, P times Q will give you P. Okay, Temilade, you understand? Akiko, may understand. Aisha is fine. Thomas, okay, so I can continue. So what we need to do is just to say PQ divided by Q. So to get P, all we need to do is to say this divided by this. Right? Are we fine? You get where I'm going to now? Okay, so we are flowing together. So to get the actual price growth now, all I need to do is this minus 1. And then you convert this to percentage. So price growth for the, so I just use 2% and 8% as an example. So what this means is this real GDP, that's volume growth, price growth, and revenue growth. So what this means is our volume growth was 2% using the GDP, real GDP growth proxy, and our total revenue growth was 8% using our nominal GDP proxy. Now, by extrapolating these two, we got a growth rate of 5.9% for price growth. So so I think we understand to this point. So now, what this means is the entire industry grew at a rate of 8%. So this is 2022. So this example is 2022. So what you need to do is look at CAP's revenue growth in 2022, 35%, right? So what you need to do is CAP grew at 35%. This is just a random figure. So if you check the GDP reports, it might actually be maybe 40% or 50%, right? If the entire industry grew revenue by 8% and CAP alone grew revenue by 35%, it means CAP grew faster than the industry. So if you observe similar trend in 2021, 2020, when you extrapolate the industry figures, and you are seeing that, oh, CAP has been growing faster than the industry, you can now look at it that what is making CAP grow faster than the industry? You look at price growth for the industry, 6%. So you can decide to assume that CAP does not control prices. So now again, you can, I'm just saying this is an assumption, right? If you assume that CAP does not control prices, that whatever price the industry dictates is what CAP takes. So if the industry price increased by 5.9%, that means CAP price will continue to grow at the industry rates. So based on your analysis, when you look at the factors in the entire industry, that is based on your research now. That is where your hard work comes in. You read about the paint industry in Nigeria. Do you think the paint industry in Nigeria is going to grow? What's going to drive prices? So based on this, if historically, maybe in 2022, price grew by 5.9%, in 2021, maybe it grew by 2%, in 2020, it grew by maybe 3%. You can look at it and say, okay, are prices going to continue to increase? If prices continue to increase, will consumers still be able to afford to buy paint? Those are all things that those are things that you have to factor. So all you need to do is you extrapolate for previous years like this, volume growth, price growth in your revenue model. So what you just do is you copy this. This is just my own style, so don't mind me. So you have price growth, and then you have volume growth, right? This will now be revenue growth. So you extrapolate for all these years using the method I taught you. You get price growth and get revenue growth. So make sure you put it here. Maybe you put it here, industry growth analysis. Because you want to use the industry to extrapolate for CAP. You put it there and then you extrapolate for all these years. When you extrapolate for all the years, you have revenue growth for industry. You can now put CAP revenue growth under here, right? When you put CAP revenue growth here, you can now use whatever, based on this here, you extrapolate for the industry. So based on all the, whatever figure you have here, so maybe if you have 5% here, 4%, oh, sorry, let me change this to... Sorry that, we have to take the class this way, I've even short my time so much, and I still need to show you PPE, I still need to show you all those other working capital and the likes. But let's just go as we can. If you are tired already, please just let me know so that I will not be burning energy to explain, whereas you're already exhausted. So let's say this was what you got from all your historical extrapolation. You can now look at it and say, based on your research, based on your findings, maybe you discussed with people that build houses, you discussed with, professionals in the paint industry, whichever approach you take, that is real life work, of actually being an analyst, right? You make all those findings. You can say, oh, I think the paint industry will grow faster than it has been growing historically. And then you have your forecast. So I like, yeah, I like you separate whatever you have. You can put your focus in a different color. I mean, that's financial modeling techniques and all those things, but that is outside the scope of this class. So based on your discussion with, and your research, you've read reports and all, you believe that the paint industry will continue to grow, even faster than the past 5-year average. The past 5-year average was about 5%. So you can expect that over the next 5 years, I expect the paint industry to grow at a faster average. So maybe at an average of, say, 8%. So you can use a flat 8% all through, or you can decide that, oh, based on your research, you expect that the growth rate will be faster in the first 2 years. Maybe there's a lot of housing projects to be done next year and things like that, and then subsequently it will subside. Or, consumer income is expected to improve significantly over the next 2 years, or you might even start slower. So it might be that, oh, over the next 2 years, the growth rate will still be slow, but then it will pick up in subsequent years when all the economic reforms and economic policy of the Bola Tinubu presidency begins to permeate through the economy. So you might say, oh, next year it will be 4%, then it will be maybe 6% next year, and then maybe the next year it will be 10%, then maybe 11%. This is based on your subject, this is based on your own reasoning. But remember, you must have adequate basis to back this up. So this average of this now is 8%. So if you expect that over the next 5 years, the volume sold of paints in the industry will grow by 8%, right? So depending on how so you just see my thought process in arriving at that. Then you also look at price. For price, what you need to do is you need to also do research on demand for paints and the supply. Because remember, price is basically dictated by the demand and the supply. So if you expect that there will be strong demand for paints in the future, and remember, there are other things that could even affect price. There could be things like, if cost increases, the company can decide to increase price, like what happened in 2021 and 2022. But again, you have to factor all those things. So if maybe you expect a significant increase in cost in a particular year, and you believe that, oh, CAP can control prices, if they can pass on the increase. So maybe paint is an elastic, or is it an inelastic commodity? Yeah, it's an inelastic commodity such that consumers are not sensitive to price changes. And if their cost increases, CAP can easily increase their prices and consumers will not reduce their consumption. So, you can assume maybe price increases here by 7%, maybe in 2024, you expect a steep increase in price. You can, maybe you have 25% here, maybe 15%, and then you expect prices to stabilize in the 2 years after. So maybe 3%, 3%, right? And then you have this. So you cannot calculate the total growth rate for the industry. And all you need to do is just 1 plus, remember the algebra formula, 1 plus this times 1 plus this minus 1. So this is, let me do it this way. Yeah. And then you have 11%. So based on your forecast, you expect revenue for the entire industry to grow at this rate, right? So what you can, what to now get CAP's revenue growth rate itself, what you can now do is you compare CAP's revenue growth rate historically compared to the industry. So you can do like CAP to industry. And you just do, so let's say, okay, let me calculate for this. Are you lost? Okay, can I go by calculation again? So basically, right, you have price, you have quantity. So you want to get PQ. PQ is going to be what? P times Q, right? So 7.7% times 4%. But remember, right, you can't just say 7% times 4%. You can't just say that because you won't get a reasonable answer because of mathematics. Remember in mathematics now, if you are going to multiply percentages to get another percentage, you have to do 1. So this 7% will be 1.07, and then 4% will be 1.04, right? And then basically this is going to, so when you're calculating, to be 1.07 times 1.04. And then this minus 1. And then you have your answer. Okay. Okay, you got it now. All right. So man, we've overused our time, but nobody's telling me to stop. So let me just.
Oh, please. I already. Hi. Good evening.
I should stop.
Not stop. I just wanted to confirm. Will this be done by 7? We have
Yeah, I'll
90
be done by
minutes to
7.
7. You'll be done
Yeah,
by
I'll
7.
be done by
Okay,
7.
that's fine.
I'll
All right.
Sorry, is the volume of what I was given to teach,
Sure, that's fine.
So let's do, okay. So no, this is for this year. So let's just assume CAP revenue growth rates for 2018. Let's just assume this was 10%, right? Because we don't have the figure. We didn't calculate it here because we don't have for 2017, so we are not able to calculate the growth rate. So let's just assume this was 10%. What you can do is you can say CAP is growing faster than the industry. Remember, all these figures are assumptions. So you have to get the real figures yourself, right? When you are building your model. So you do CAP growth rate divided by the industry growth rate. I don't want this in percentage. I want this in times. So this is 1 point. So CAP is growing at like an average of, so if you calculate the average, 2.3 times to the industry. Remember, the reason why you have this kind of wild figures is because these figures are abstract figures. Because I'm sure in this kind of year, the industry growth will definitely be more than 12%. It will be more than, because whatever price increase CAP did will definitely have an impact on the total industry figures, and it will have an impact on this. So but let's just, continue using this assumption. I'm just using it to teach you a thought process. This is my thought process regarding how you can forecast for CAP. Remember, I've never built a model on CAP before because they are not, an actively traded stock like that. So they're hardly in demand on the stock market. So most times we don't really focus on CAP. But yeah, the average, so CAP grows revenue at an average of 2.39 times the industry growth. Yeah, 5-year average, 5-year average. When I calculate the average through the past 5 years, so it tells me 2.39 times. So when I want to calculate growth rate for CAP, I can say, if over the past 5, you look at it and say, do I expect CAP to continue to dominate the industry? Because actually, in real life, CAP is, I think, the number one player within the paints and chemical allies industry in Nigeria. Actually, I think CAP is number one, and then the likes of Portland Paints, Premium Paints. I think one of those two were acquired the time ago. I can't remember. But yeah, the whole idea is, if you expect CAP to continue to lead the industry, then you can say, I expect them to actually continue to grow faster than the industry going forward. But if you expect that, I think CAP will lose its grip over its control of the industry, maybe its control over pricing, or you expect the quality of their products to begin to drop, or maybe the quality of their products is already dropping and consumers are already complaining. Maybe you did a consumer survey of, different paints. That is another angle again that I'm bringing in. You can do a survey of consumers, people that buy paints. Which one do you prefer? Are you enjoying CAP? Will you continue to patronize CAP in the future compared to Portland, Premier, and other smaller regional players? Based on your industry analysis, that is, I'm sure they've taught you industry analysis. Based on that industry analysis, you can now decide, I think CAP will actually grow at a lower pace compared to the industry. So I expect that it's the rate at which it's growing faster than industry will reduce. So you can say, I expect it to, let me apply a, say, 30% discount to this previous 5-year average. So I'm saying if I'm applying a 30% discount, I'm saying over the next 5 years, I'm expecting CAP to grow at 0.7 times 2.39 of the previous way it used to grow faster than the industry. Please, do you understand what I just did there? Do you understand what I just did in relation to the discount? Deborah said no. Okay, let me take it again. So after doing our industry analysis, we came to the conclusion that CAP will grow at a slower pace compared to the entire industry, right? So, at a slower, so let me phrase it better. Historically, right, based on the data we have here, CAP has been growing at 2.39 times the growth rate of the entire industry because it is an industry leader and it controls the industry, right? So based on our assumption, we expect CAP's grip on the industry to reduce. Not necessarily that it will no longer be an industry leader, but we expect it to reduce. So it will still be growing faster than the industry, but it will be growing, the rate of growth, the rate at which it is growing faster than the industry will reduce, right? So if that rate will reduce, what I can do is I can apply a discount to the rate at which it has been growing faster than the industry in the past. So I apply a discount to it to estimate the rate at which it will be growing faster than the industry in the future. Deborah, are you with me? Because you're doing what I said. No, Deborah, is he a bit clear now? Okay, thank you. That's great. Nice one. So we have 1.67. So if I want to calculate CAP's revenue growth rate, all I just need to do is to say, if the industry is growing by 11%, CAP will grow 1.67 times faster than the industry. So I lock it and I just drag across. So my estimation is that CAP's revenue will grow by 19% in 2023, 54% in 2024, and so on and so forth. And then I just come to my income statement and I say equals to this times 1 plus this, right? You know how to calculate growth rates now. And then I drag through. And then this will be my revenue forecast for CAP. So everybody, do we understand all this? I want to move fast. Are we good? I assume we are. Yes, okay. So that's the revenue forecast. Now, to forecast all the remaining items like this in your balance sheet, I mean in your income statement, they are straightforward. Everything just do as a percentage of revenue. So you come to IS assumptions, right? Let me quickly do this. This is straightforward, very, very easy. Just look at this. Just go with me so that you don't get lost. Because I'm going to do it quick because I want to show you PP and working capital. Once I show you PP and working capital, that will come to the end. So we have cost of sales. So cost of sales is one item we want to forecast. So we write all the items we want to forecast here. Cost of sales, you don't need to forecast. I mean, you're not forecasting gross profits. Gross profit is basically revenue minus cost of sales. You get the idea. Okay. We want to forecast selling and distribution expenses, other income. So you can see this write back or payment on trade receivables. You don't need to forecast it. You can see that it is inconsistent. Like it's not a significant portion. It's not, you don't need to forecast it. It does not have any consequential impact on your outcome. So, and besides, there is no predictable way of forecasting these impairments. So just leave it out. So we'll go to IS assumption. So let's paste all the things. So these are the things. So let me just pick these items. These are the things we want to forecast. So all you need to do is bring all the historical cost of sales here first, right? So we bring the historical cost of sales here. What we want to do is, you will understand what I want to do now. And then you calculate your cost margin. Remember, under ratios, cost margin, remember, I hope you can remember cost margin. What's the formula for cost margin? Put it in the chat box. Put it in the chat box. Formula for cost margin. While I'm formatting these cells, put it in the chat box. Formula for cost margin. Oh yeah, sharp. I have 10 minutes left. Oh yeah. Cost of sales divided by revenue. Perfect. So we just do cost of sales divided by revenue. I think you can see where this is going, where I'm going with this here. 52%. So this is cost of sales historically, right? So all you need to do now is to forecast the cost of sales, cost margin for the next few years. So based on your analysis, right, so based on your industry analysis, are you expecting costs to increase for paint producers? You know, will Naira continue to lose value to the dollar, which will affect their cost? You know, do you expect wages to increase? You know, all those things like that. To do all those analysis. So if you expect it to increase, maybe from the 60% it is, maybe you expect an average of, say, maybe 62% over the next few years. You just put 62%. Whatever figure you are getting, whatever figure is your assumption. Remember, these are assumptions. You put the figure and then you basically say 62% times revenue. And that will be your cost of sales for 2023. Then you go to income statement, you say equals to minus. Remember, I'm putting minus because our figure here is positive and cost of sales should be negative. So I put minus in front. And then you link it to it and then you drag through. And then automatically your gross profit you calculate because, you know, you just subtract. So you do the same thing for selling and distribution expenses, administrative expenses, and other income. You do the same thing for all those items. And then you have all your figures for year, and then you have your operating profits. Now, finance income and finance cost is something I should teach you in combination with total debt and forecasting cash. There are so many things you can't cover, but please go and read how to forecast finance income and finance cost from the materials I gave you. Finance income is basically just do finance income as a percentage of your cash and cash equivalents for the year, because for finance income is basically interest on their deposits at the bank. So just do 327 divided by this, then you get the yield that they earn on their cash and cash equivalents. And then So based on the historical numbers you have, you can now look at it and say, do I expect interest rates to continue to increase in the future? If you expect interest rates to increase in the future, that yield will also increase, and the like. So, and then once you forecast that yield, you multiply, I just hope you are following and understanding what I'm saying. I'm sorry, I'm just flying. Let me quickly go to balance sheets, right? Let me quickly go to balance sheets. So let me quickly go to balance sheet and then teach you PPE, and I'll teach you working capital, and then we'll call it a day. For PPE, I always advise you create a PPE schedule. I always advise you create a PPE schedule if you want to do a thorough job, right? But there are shortcuts, right? There are shortcuts that you can use. So the shortcuts you can use is what some people do. Let me tell you, what some people do is they just apply a growth rate to total assets. They estimate total assets. Once they estimate total assets, remember vertical analysis, right? If you remember vertical analysis, you understand this. Once they put a growth rate, maybe they expect total assets to grow by maybe 5%. Then they get total assets, and then what they now do is they use maybe the historical percentage. So whatever percentage PPE is as a percentage of total assets. So let's say PPE is 13% of total assets. Whatever they have here, based on the growth rates they apply, they will just say that 13% times this. But they will have a separate sheets where they would do those calculations on, and then they just link it and just do that short rule to the answer. But if you are going to do a proper job, I always advise you prepare a PPE schedule where you have your opening PPE. Let me use, give me a minute. Let me open a model. Most recent one. So I will use this to explain. So please, can you see the new model I'm sharing? Please put it in the chat box. Can you see the new model I'm sharing? Oh, okay. Okay, I'm coming. Let me do this. Trying to be quick. Can you see it now? You should be seeing it now. Okay, you can see it now. All right. So I'm using one of the models I've built in the past. So you can see these are my historicals, income statement, historicals, balance sheets, cash flow statements. I embedded my horizontal analysis here. You can see my horizontal analysis. Then this is my my vertical analysis, percentage of sales, percentage of sales, percentage of sales, percentage of sales. So this is what I was trying to show you about. So for this cost model, this one I broke it down into the items that made up cost of sales, and then I did a forecast for each one, but you don't necessarily need to do that, So this is general and administrative expenses. You can see what I did. I brought all the historicals, and then I calculated as a percentage of revenue, right? And then I did a forecast for all the following years, and I calculated it. So this is what I mean by elaborate. So this is a revenue model. This is just to forecast revenue alone. This amount of work that you can see here is just to forecast revenue for this company alone. But so let me quickly show. This is what I want to show you. PPE. So what I always advise is to prepare a schedule like this, right? Where you have you always get this from the notes to the accounts. So when you go to the balance sheet, when you go to the, what can't I see? You go. So I'm not able to see. I should be able to take this up now. Okay, top to bottom. Okay, I think that works. Yeah. So if you look at can you see this? You can see the financial statement I'm sharing, right? So if you look at PPE, you can see note 14. By the time you go to note 14 in the financial statements, you would see the breakdown. You don't need to pick it per item, just pick the total. So this is the opening balance, this is the addition. This is the assets that they sold that year, and then any other item. So you just pick it out from there. You pick it out from all the historicals and you populate your model. Just the way I did this year. I just hope you're able to follow, right? So once you do that, all these ones are the historical amounts. So it will be there. You just need to do it and add, the one you are adding and the one you are subtracting. You have the figure there. And then to now do the is just the addition. Just forecast the capex. That is, how much assets are there? Because the truth is, there is no clear pattern to forecast some of all these other items. So just forecast the addition, focus on the addition, and you look at it that what's historical capex rate, right? And sometimes you might be aware that, CAP wants to make significant capex investments over the next years. So the percentage of revenue. So I normally express capex as a percentage of revenue to get an idea of how much of revenue they spend on buying new capex, right? So based on the historical amounts, I get an estimate. I just, have a subjective amount. So it might be that, if you expect them to continue to spend based on what they've been spending historically, you can just have maybe 15% or 16%, in this case, all true. If I'm expecting that there'll be an increase in capex, maybe they intend to make some acquisitions and some things like that, I can say, if the average of the past 5 years has been maybe 15%, I'm expecting in 2022 or 2020, in this case, this is an old model. If I'm expecting that, based on the time I was building this model, if I'm expecting that it to be average was 15%, I'm expecting an increase in capex, I can say, let me say 20% of revenue. And then once I do that, that gives me my total. That gives me my capex. I just say 20% of revenue, and then I have the figure here and I sum it together and I get this. Sorry. And then you forecast depreciation. I think I will just stop here. You forecast depreciation. To forecast depreciation, you have the historical amounts. So if you go to the income statement, the notes to the account.
Are you done?
I'm almost done. 2 minutes.
Okay, just finish up.
Yeah. So you pick the depreciation figure. You have the depreciation figure here, accumulated depreciation. So you just pick the total to populate your historical numbers. So once you fix in your depreciation, all you need to do is to just forecast the depreciation for the year. And to forecast, what I typically do is I do depreciation as a percentage of oil and gas assets. So let me just stop here. We've been going for 3 hours now. Let me stop here. What I can do is I will send a sample model across. Maybe this will not be ideal. I will send you a different model entirely. Maybe one for a commodity company, like maybe like similar to CAP. I'll send a financial model across to the facilitators, and then maybe if they are happy to do that, they can share with you guys, and then you can sort of learn from that model. You can learn from that model and use it to sort of build your model. So if they are willing to allow that, I will happily send the model across. I hope that will help. So that brings me to the end of the class. Thank you very much.
Thank you so much. Thank you to everybody here. Yeah, we're more than happy to share the model you will share to everybody. If there are any questions, please, we're happy to take questions before we round up. It's good that we do it and do it well, do whatever we're doing well. If you have any questions, please indicate so that we can take the questions before we round up. Just to reiterate, the group chat is there for you if you have any questions at all. Because I know that even this class, Ayorinde, are you truly done with this session?
I think we just have to end it here. It's already too. We can't go. I've not covered.
No,
everything.
I mean not even today. I'm saying, are you done generally with this session?
I don't get.
Is
Am I
there...
done with everything I want to do?
Yes, yes.
Not actually.
Not actually. So yeah, so when he shares the model, if there is need to have a third session, I guess we might have to put that in the book. So we might have to look at that as well. So someone said they have a question. Akinkumi Adebayo, okay, he's saying which is ideal to forecast depreciation? Which is ideal to forecast depreciation first or capex?
It's ideal to forecast capex first. So you forecast your capex because you buy first before you depreciate. So it's ideal you forecast capex first, and then you forecast depreciation, because your depreciation is going to be a percentage of your average PPE. So if you look at this formula, it is to calculate the charge for the year, depreciation charge for the year. It was 6% of the average of these two. So you need to have forecasted your capex because you are going to depreciate that capex that year. So it's always better to forecast capex. In fact, that is the proper way. Forecast capex before you forecast depreciation.
Okay, I hope that answers your question, Akinkumi. I hope that answers your question. All right, it does. So again, please, the group chat is there not just for us to pass across message. If there are any questions, if you run into a jam at any point, especially with this financial analysis or even any other session that we've had so far, the model will be shared. You can play around it. We've shared Excel courses for people to play around with. Please play around it. If you have any questions at all, always feel free to ask. Always feel free. There are no wrong questions. Always feel free to ask your questions on the group chat, or even call. If you are shy on the group chat, you can message any one of the facilitators too. Okay. Please share the earlier Excel file they've asked for. I already asked for you. You have to share the earlier Excel file that was asked for. That's from Akinkumi Adebayo.
Yeah, no problem.
All right. All right. Thank you all so much. We'll see you tomorrow. Tomorrow's class is for risk and it's by 1 p.m. So, okay. Could you send the link for the group chats? Okay. Oh my God. Let me see. Chidima. All right. All right.
So can I
Please,
quickly
this
drop
session
off?
is... Yes, yes, you can. Thank you. We'll let you know if anything changes regarding the schedule for this, for a proposed next class.
Okay, all right, no problem. So
Yeah.
thank you, everyone.
All right,
I wish you all good luck. I'll share the models and send you. Cheers.
Please don't end the session yet. I want to drop the link to the group chat. Let me see. I just realized I've never actually shared. I can't see where to share the link. Please, if anybody can drop the link to the group. Okay, I've seen it. All right, copy link. Okay, Chinema, please confirm that you've seen it. Okay, please. Okay. So I'm going to end the session now. Everybody have a good evening and see you tomorrow.